Please like, share, and subscribe. Wishing you happiness and good luck every day.
You know, the stock market can sometimes feel like a high-stakes casino, right? It's just a lot of noise, a lot of hype, and a ton of confusing jargon. But what if you could just filter all of that out and approach it with a clear, simple system you can use again and again? Well, today, that's exactly what we're going to do. We're diving into the core ideas from Apurva Parikh's book to build a solid framework for smart, long-term investing.
And this question, this really gets right to the heart of it, doesn't it? Is your money actually being put to work based on a solid process? Or are you just reacting to a hot tip you heard from a friend or saw on the news? That feeling of uncertainty, that anxiety, that's exactly what we're here to solve today.
And that, right there, is the real difference. It's what separates true investing from just speculating. The source material is crystal clear on this. Jumping on tips without doing your own homework is just a form of gambling. So our goal here, together, is to build a system, a set of clear rules to help you move from feeling anxious to feeling truly confident in your decisions.
Okay, so here's our game plan. First, we're going to talk about the single biggest mistake that most investors make. Then, we'll get into the right mindset for long-term success. After that, we'll build our strategy piece by piece using 3 core pillars: finding great companies, making sure we pay a fair price, and buying when the time is right. And finally, we'll wrap up with the actual tools you can use to put all this into practice.
All right, first things first. What's the biggest, most common, and most dangerous trap in all of investing? It's acting on tips and hearsay. You know the feeling. A stock is buzzing, everyone's talking about it, and that fear of missing out, that FOMO, it just kicks right in. But the truth is, without your own system, you're not really investing. You're just following the crowd.
And this quote just nails it. When you buy a stock based on a tip, you're essentially letting someone else do your thinking for you. I mean, think about it for a second. If you don't even know why you bought a stock in the first place, how on earth are you going to know when it's time to sell? That's when panic sets in, emotion takes over, and as the book points out, that is almost always a losing game.
So if we're not going to be chasing those quick, risky wins, what's the alternative? Well, we're going to play a completely different game, because smart investing isn't a get-rich-quick scheme. It's a get-wealthy smartly and surely plan. It's all about harnessing the incredible power of compounding over time.
Just take a look at these numbers. The source material lays this out perfectly. A savings account? You're looking at 24 years to double your money. Gold might take about 6.5 years. But a well-chosen portfolio of stocks has the potential to double in just over 3 years. Now that is the engine of wealth creation we want to tap into.
So how do we get to that 3.3-year doubling time? Well, it's based on this number, 22%. The author's research found that by using a systematic approach, the exact one we're building today, an investor could potentially see an average annual return of 22%. Now, of course, that's not a guarantee, right? But it just shows you the incredible potential you unlock when you have a real strategy.
And this classic quote from Warren Buffett, which is also in the source material, it just says it all, doesn't it? The market rewards people who think in years and decades, not in days and weeks. It tends to punish those who react emotionally to every little headline. So with that foundation of patience locked in, let's start building our system. Okay, so this brings us to the first pillar of our system, company quality. I want you to think of this like a pilot's pre-flight checklist. These are the absolute non-negotiables. We run these checks before we even start thinking about the stock price. We're looking for a durable, healthy, well-managed business. This is all about safety first.
So what does a quality company look like? Well, first up, it's got a long history. It's been in business for over a decade, which proves it can survive the tough times. Next, we want strong leaders who have real skin in the game. When the founders own over half the company, you know they're invested right alongside you. We also want a business with very little or no debt, which means it's not fragile. And finally, the engine itself. We need to see consistent growth year after year, backed by real cash coming in. A company that ticks these boxes is one that's built to last.
Okay, so we found a fantastic, high-quality company. We're good to go, right? Well, not so fast. That's really only half the battle. There's an old saying in investing, there's no such thing as a great company, only a great stock. And a great stock means buying that quality company at a reasonable price. This brings us right to our second pillar, paying a fair price.
The source gives us 3 key things to look at to check the price tag. First is return on equity, or ROE. The easiest way to think about this is like a report card for the management team. For every dollar of shareholder money they use, how much profit do they make?
We're looking for an A grade here, 15% or higher. Next is ROCE, which is similar but gives us an even broader picture of profitability. Here we want to see over 20%. And finally, the famous PE ratio, which basically tells us if the stock is a potential bargain compared to its competition.
Let's break down that PE ratio, because it can sound complicated, but it's really not. Just think of it as the price tag on a company's profits. A high PE means you're paying a high price for each dollar of profit it makes. A low PE means you might be getting a bargain. But here's the key, and this is super important. You have to compare apples to apples. A tech company's normal PE is going to be way different from a utility company's, so you always check it against its direct peers.
All right, we've got a quality company and we've got a fair price. We are almost home. This final pillar, the last piece of the puzzle, answers the big question. When is the right time to actually buy? Because even the best company in the world can see its stock price fall. This is about making sure the market's momentum is on our side.
The idea here is really simple. We want to swim with the current, not against it. We're looking to buy stocks that are already in an uptrend, the kind that are making higher highs and higher lows. We want to avoid being the hero who tries to buy a stock that's in a free fall. You've probably heard the old saying about catching a falling knife. Yeah, that's what we want to avoid. It's a game that's really, really hard to win.
So, how do we check for this positive momentum? Well, the book gives us a really simple tool for this, the Relative Strength Index, or RSI. Don't let the name scare you. Just think of it as a momentum meter for the stock's price on a scale from 0 to 100. The source suggests looking for a reading above 60. That's a sign of strong buying pressure, and it confirms that the uptrend is healthy. It's kind of like the final green light before you hit buy.
Okay, so that's our three-pillar framework: quality, price, and trend. It's a great theory, but I know what you're probably thinking. This all sounds great, but how in the world do I actually find these companies without spending my entire life buried in financial reports? That is an excellent question, and this is where we move from theory to practice.
The good news is you don't have to do this by hand. You don't have to go digging through thousands of reports. The author points out there are these amazing free online tools called stock screeners. A site like screener.in, for example, is like a powerful search engine for stocks. You can tell it the exact criteria we just discussed, and it'll search the entire market and give you a shortlist in just seconds.
And here's what that looks like in the real world. You could literally set up a basic screen using just 4 of the rules we talked about. Filter for companies where founders own over 50%, the return on equity is above 15%, the debt is low, and the PE ratio is cheaper than its industry average. You run that simple query, and you've instantly narrowed thousands of stocks down to a manageable list of potential investments.
And this right here might be the most empowering message in the whole book. You don't need a crystal ball to do this. You don't need to be some kind of Wall Street genius to succeed in the long run. What you need is a disciplined, repeatable process and the patience to stick with it. That's the real secret. This quote from Benjamin Graham, who is Warren Buffett's mentor, is the perfect way to sum all this up. In the short term, yeah, the market is a popularity contest. It's a voting machine driven by hype and emotion. But over the long haul, it becomes a weighing machine. The true value, the actual weight of the business, its profits, its quality, that's what ultimately matters. Our entire system is designed to focus on the weigh-in, not the vote.
So there you have it, a complete system based on finding quality companies at a fair price in a positive trend. We've seen how to turn that theory into an actual process you can start using today. This framework isn't the finish line, it's your starting block. It's how you can stop gambling and truly start investing. So the only real question left is, are you ready to start weighing?
Hello and welcome. Look, we all work hard for our money, right? And we all want that money to start working just as hard for us, building a better future. But when you look around, there are so many options. So what's really the best way to create long-term wealth? Well, today we're going to tackle that question head-on. Why should you seriously consider investing in stocks? Okay, let's kick things off with this brilliant idea from the legendary investor Benjamin Graham. So what's he really saying here? He's saying that on any given day, the market is like a popularity contest, a voting machine, driven by headlines and hype. But if you stick around for the long run, all that noise fades away. What matters is the true, solid value of a business, its weight. This is the mindset we need. We're not just gambling, we're investing in the future success of real companies. All right, so here's our game plan. We'll start by looking at two different paths for your money. Then we'll climb the traditional savings ladder that most of us are familiar with. After that, we'll dive into how the stock market really works as a wealth creation engine. We'll even compare putting money in a bank versus owning a piece of that bank. And of course, we'll talk about the magic of compounding and finish up with the most important part, the crucial first steps you need to know. Let's get into it. First things first. Before you invest a single penny, you've got to know what that money is for. I mean, think about it. The money you're saving for a vacation next month is totally different from the money you need for a house in a few years, or for your retirement way down the road. So we need to break our goals down into three simple buckets: short-term, medium-term, and, you guessed it, long-term. Now, let's match the right tool to the right timeline. For those short-term goals, anything inside of a year, debt funds are generally a safe bet. For the medium term, say 1 to 5 years, a mix of debt and stocks can give you a nice balance. But for the big, long-term goals, 5 years or more, that's the sweet spot. That's where stocks and gold have the room they need to really grow. And hey, look at that last point. It's the most important one on the screen. None of this investing talk matters if you don't have your insurance sorted. That's your financial bedrock, non-negotiable. All right, let's switch gears and talk about the path most people take. You know the one. These are the safe, familiar options that we're all taught about from a young age. Let's call it the traditional savings ladder. And right there, on the very bottom rung of that ladder, you've got the standard savings account. It feels safe, you can get your money out anytime, and it pays you about 3%. Just kind of let that number sit there for a second. 3%. Now, if you take one step up the ladder, you'll find the fixed deposit, or the FD. You lock your money away for a bit longer, and for that commitment, the bank gives you a little more, somewhere around 5%. It's better, no doubt. But is it really building wealth for you? And this slide really puts it all into perspective. Forget the return column for a minute and just look at the doubles in column. With that savings account, it would take 24 years to double your money. 24. Even with an FD, you're looking at 14 years. You see, these options feel safe, but that safety has a hidden cost, and that cost is time. If this is your only plan, you're giving up a massive amount of growth just for that feeling of security. So, if that slow and steady path just isn't going to cut it, we need a different approach. It's time to completely change how we think about the stock market. Let's get rid of the idea that it's some kind of casino. Let's see it for what it truly is. The engine that powers our entire economy. And maybe, just maybe, the engine for your own personal wealth. I mean, just think about this. During the global pandemic, when basically the whole world was on lockdown, the stock market didn't close for a single day. Why? Because it's absolutely essential. It's how new ideas get funded, it's how companies grow, and it's how we measure the financial health of the entire country. It's not a sideshow, it is the main event. And here's the payoff. Just look at this comparison. We saw the FD was chugging along at 5%, gold a respectable 11%, but the stock market? Historically, it's averaged over 20%. Let that sink in for a moment. This isn't just a little better. This is a complete game changer for what's possible with your money over time. Now, to make this really hit home, let's move away from percentages and talk about a real-world story. It's a tale of two friends, one simple choice they made, and two wildly different outcomes. Both of them decided to put their trust and their money into one of India's biggest banks, the State Bank of India. But they went about it in very different ways. And here you have it. 20 years down the line, the friend who put 50,000 rupees into a fixed deposit, the safe route, he ended up with 4 lakhs. Not bad at all. But his friend, the one who invested the exact same amount of money into shares of the very same bank, he ended up with 122 lakhs. No, that is not a typo, 122 lakhs. The difference is absolutely mind-blowing, and it all boils down to one thing. One was a lender, and the other became an owner. So what's the big secret? It's right here. It's incredibly simple. The first friend was a lender. He gave his money to the bank, and the bank paid him a small fixed fee for it. Then the bank went out and used his money to make much bigger profits. The second friend? He became an owner. By buying a share, he bought a tiny slice of the entire bank. He wasn't getting a fee. He was getting a piece of all the profits the bank was making. He was on the inside, sharing in the success. So now we get it, right? We see the power of owning a piece of a solid, stable company like a bank. But what happens when you take that same idea and apply it to a company that's not just stable, but is growing like a rocket ship? Well, that's when the story goes from great to, well, to something truly extraordinary. So let's play a little game of what if. Imagine it's 1993. A little-known tech company called Infosys is having its initial public offering. What if you had the foresight, or maybe just the luck, to invest just 10,000 rupees back then? What do you think would happen? So here's the journey. You've got that modest 10,000 rupee investment back in 1993. You put it in a drawer and you just wait. For nearly 3 decades, that company grew and became a global powerhouse. So what was that little investment worth by the year 2022? Any guesses? 155 million rupees. I mean, it's a number so big it almost sounds fake, but it's real. That is the incredible, explosive power of owning a piece of a phenomenal business and just letting compound growth do its thing for decades. Now, obviously, this is a once-in-a-lifetime example, but it perfectly shows the sheer potential of being a long-term owner. Okay. Seeing a number like that is exciting. I get it. But excitement without a plan can be dangerous. So let's bring this all back down to earth and talk about the practical, logical stuff you have to know. Honestly, this is the most important part. Understanding the why and the how before you ever put a single dollar on the line. Here's the basic logic behind this whole owner mindset, broken down into 3 simple steps. First, the bank takes your deposit and lends it to a company, charging them, say, 9.5% interest. Step 2, for that company to even stay in business, it has to earn way more than that. Let's call it 19%. Step 3, when you own shares in that company, you get to skip the middleman. You are participating directly in that higher profit that the business is creating. You're right where the real value is being made. And that brings us to our final and maybe most important slide. I need to be crystal clear here. The stock market is not for your emergency fund. This is money you can afford to not touch for at least 5 years. And it's not a lottery. It takes real skill and analysis. You can't just invest based on a hot tip from your neighbor. And while the Infosys story is incredible, a more realistic and still fantastic return for a skilled investor is somewhere in that 15 to 18% a year range. So we end up right back where we started, thinking about your money and your future. As you go out and put your hard-earned cash to work, you now understand the fundamental choice that you have in front of you. Are you going to be the person who simply lends your money out for a small fee? Or are you going to be the person who owns a piece of the very engine that drives our economy forward? The entire potential of your financial future could hinge on how you answer that one question. Hello there and welcome. A lot of people think the stock market is this super complicated world, something that's only for the financial geniuses, right? But what if I told you the real secret to successful investing isn't buried in some complex spreadsheet, but it's actually hiding in plain sight, right in your own daily routine? Let's dig into that, because your everyday life might just hold the key to becoming a much smarter investor. And we're going to start with a classic quote from the man himself, Warren Buffett, because it just nails the theme for today. We don't have to be smarter than the rest. We must be more disciplined. See, this isn't about having some genius-level IQ. It's really about having a simple, clear strategy and then having the discipline to stick with it. That's the big idea we're going to explore. Okay, so let me ask you a question. Picture a stock picking contest. Who are you putting your money on? A team of super trained financial analysts with fancy degrees, or a group of 10-year-olds? I know, it sounds like the setup to a bad joke, but the result of a real-life experiment like this is probably going to blow your mind, and it tells us something really powerful about how all of this works. So here's what we've got on tap. We're going to kick things off with that surprising contest I just mentioned. Then we'll figure out what this common sense advantage is all about. After that, I'll show you how you can literally find stock ideas just by living your life. We'll cover the nuts and bolts of how to get started, and we'll wrap up with the incredible, almost magical power of being consistent. All right, let's dive into it. First up, this fascinating contest. Someone basically decided to put the whole idea of expertise on trial. They set up a showdown between seasoned financial pros and a group of complete newbies. We're talking kids here. So let's meet the 2 teams. So in this corner, we've got Group 1, literally a bunch of 10-year-old kids. And in the other corner, Group 2, a team of heavy hitters, chartered accountants, financial analysts, the whole 9 yards.
The challenge was pretty straightforward. Each team picks 5 stocks, and they have to hold on to them for 10 years. It was the ultimate battle, pure gut instinct versus years of professional training. So let's check out the strategy from the kids' team. Honestly, you can't even call it a strategy. It was just simple. They picked companies that made stuff they knew, that they used, that they loved. So they're thinking, I love Cadbury chocolate, let's pick that. I love Disney movies, let's pick that one too. And of course, the company that makes Barbie. That was it. No spreadsheets, no research reports. Now, the experts, well, they did exactly what you'd think they'd do. They brought out all the heavy artillery. We're talking deep dive research, complex financial models, technical analysis where they're staring at charts all day. They're even studying the backgrounds of the company's founders and sizing up all the competitors. It was a thoroughly professional, very sophisticated approach. And here it is, the big reveal. After 10 long years, they crunched the numbers, they tallied up the results, and the portfolio chosen by the kids beat the portfolio that was so carefully put together by the financial experts. Just let that sink in for a second. The kids won. So now the billion-dollar question is, why? How on earth did that happen? And that why is really the whole point of this. It brings us right to this idea of the common sense advantage. So let's pull back the curtain and see exactly why a simple, straightforward approach beat all of that complicated expert analysis. And this is it, right here. It's so simple. It's brilliant. The children were connected to what we might call the ground reality. They weren't looking at abstract numbers on a computer screen. They were picking companies based on their actual real-world experience. They saw their friends eating the chocolate and playing with the toys. That was the research. And the experts, with all their data, might have completely missed that simple, powerful truth. So let's give this a name, shall we? Let's call it common sense investing. And all it is this. It's the principle of investing in companies whose products and services you already know. You use them, and most importantly, you trust them in your day-to-day life. If you already trust the product, you've got a huge head start in understanding the business. Okay, so this is where things get really practical. And honestly, this is the fun part. We're going to take this idea and put it into action. This next bit is all about how to use your own life as the best stock finding tool on the planet. Forget fancy software, you just need to start paying attention to the world around you. Here's a little exercise you can do, maybe right after this. I like to call it the daily audit. It's easy. Just get comfortable and just walk through your day in your head. Start from the second your alarm clock goes off. What's the first thing you touch? What products do you use? What services do you interact with? Just make a big list. And for every single thing, try to identify the company that makes it. And here's a little template just to get the wheels turning. What brand of toothpaste did you use this morning? What about the soap you used in the shower? The computer you're on right now? The car you drive to work? The software you use all day long? You'll be absolutely amazed how fast this list fills up. I bet you could name 50 companies without even trying too hard. And this is where it all clicks into place. For every single one of those products on your list, you've already made a decision. You've given that company your vote of confidence as a customer. You trust their quality, you trust their value. So the next logical step is to ask yourself, why not become a shareholder? Why not become an owner? Because when you do that, the CEO and the entire management team are, in a very real way, now working for you. Okay, so you've done your audit. You've got a list of companies you know, you like, you trust. The obvious next question is, all right, how do I actually do this? So let's break down the practical steps, because getting started is so much easier and less scary than most people think. To invest in the stock market, you really only need 3 accounts, and they usually come packaged together. First, a bank account, which you've probably already got. Then you need a trading account. That's what you use to actually place the buy and sell orders. And finally, a DMAT account, which is like a digital wallet that holds all your shares electronically. You can open these up pretty much anywhere. Big banks, special brokerage firms, you've got lots of options. And now we get to the big one, the question that stops so many people before they even start. How much money do I actually need to get in the game? Do you need to have a huge pile of cash just to begin? The answer might really surprise you. You can get into the market, you can buy your first share of stock with as little as 1,000 rupees. That's it. So you see, the biggest barrier to entry usually isn't money. It's just taking that first step to get started. And that leads us perfectly into our final and maybe the most powerful section, because getting started is great, but the real magic, the thing that builds true wealth, happens over time.
So let's talk about the incredible power of just being consistent, how small, regular habits can grow into an absolute fortune. To really see how this works, let's look at a quick example. Let's meet a guy named Mr. Kulkarni. He's 30 years old, and he decides he's going to start putting just a little bit of money aside every single month, no matter what. So here's his simple plan. He starts out by investing just 1,000 rupees a month. That's it. Now, each year, as he hopefully gets a raise, he increases that monthly amount by 10%. We'll assume he gets a long-term average return of about 15% a year from the market. And he just keeps doing this, month in and month out, for 30 years until he's ready to retire at 60. And what's the result of that simple, disciplined, consistent plan? By the time Mr. Kulkarni blows out the candles on his 60th birthday cake, his investment has grown to over 1.6 crore rupees. I mean, just look at that number. This shows you everything. It wasn't one big, lucky bet that got him there. It was a small, steady, disciplined action repeated over and over for 3 decades. That, my friends, is the power of compounding. So we're going to end right back where we started, but now I've got a challenge for you. Just take a look around you today. Think about your day, your commute, your kitchen, your office. What great companies, what amazing potential investments are hiding right there in plain sight, just waiting for you to notice them. Thanks so much for joining me. All right, let's talk about something that makes a lot of people pretty nervous: risk. Specifically, risk in the stock market. But here's the thing I want you to walk away with today. Risk isn't some monster hiding under the bed. It's not something to be afraid of. It's something to understand, to get ready for, and, to manage. Because honestly, knowing how to manage risk is really what separates a smart, successful investor from someone who's just kind of hoping for the best. This quote from the legendary Peter Lynch, it just hits the nail on the head. What he's really saying is that being unprepared is your biggest enemy. Look, recessions happen, markets go down. These aren't crazy, once-in-a-lifetime events. They're a totally normal part of how the economy works. The trick isn't trying to predict the exact day they'll happen. No, the key is to understand that they will happen and to be ready for it. That knowledge, that understanding of the landscape, that's your most powerful tool. So let's just be totally honest from the get-go. Every single investment out there, I don't care if it's stocks, bonds, real estate, you name it, it all comes with some kind of risk. The idea of a risk-free investment, it doesn't really exist. So our goal isn't to somehow avoid risk entirely, but to pick the right kind of risk that lines up with what we're trying to achieve financially. Now this chart, this highlights a really important kind of hidden risk that a lot of people miss, especially with those so-called safe investments. You might put your cash in a fixed deposit, and sure, you'll see that number tick up a little bit each year. But what about inflation? I mean, if you're earning, say, 4% interest, but the cost of everything is going up by 6%, well, you're actually losing money, right? Your buying power is shrinking. The stock market, on the other hand, asks you to accept more bumps in the road in the short term for the chance at much, much better growth in the long term, growth that can actually beat inflation. It's all about choosing which battle you want to fight. So what's the price of admission for that higher potential? How long do you need to be in the game? Well, the source material is crystal clear on this one. You need to be thinking about investing for at least 5 years. That's the minimum. A 5-year window gives you enough time to ride out those short-term ups and downs and really benefit from the market's historical habit of climbing higher over the long haul. Okay, so let's get into the nitty-gritty and break down risk into its 2 main types. We're going to start with what's called systematic risk. I want you to think about investing like you're navigating a battlefield. Systematic risk is the terrain itself. It's the weather, it's the mud, it's the fog, it's all the stuff that affects every single soldier out there no matter how skilled they are. And that's exactly what this is. Systematic risk is the big picture stuff. It's the risk you absolutely cannot get rid of just by picking different stocks because it impacts the whole system. It's like a giant storm cloud that rolls in and covers the entire market. When this kind of risk hits, it doesn't matter if you own tech companies or banks, everybody's going to feel it. And just look at this list. These are huge, powerful forces. Think about COVID. That's a perfect recent example, right? The virus didn't care what industry you were in. It just turned the entire global economy upside down. It hit travel, tech, healthcare, you name it. It's the same thing when a central bank makes a big change to interest rates or when the whole economy slips into recession. These are the giant waves that either lift all the boats or push them all down. And here's the absolute key on this one. You can't eliminate systematic risk. It's just not possible. You can't sidestep a pandemic or a recession with a few clever stock picks. So the strategy here isn't about avoidance. It's about being aware and building a portfolio that's tough enough to get through these storms when they inevitably come.
Okay, but this is where things get really interesting. If systematic risk is the battlefield terrain, then unsystematic risk is the specific opponent you're up against. And unlike the weather, you can absolutely come up with a strategy to deal with a specific opponent. This is the risk you can actually do something about.
And there it is, right on the screen. See that last part? Diversifiable risk. That is the magic phrase. This is risk that's locked into just one company or maybe one specific industry. It's isolated. It's the kind of risk that a smart investor can strategically work around. I mean, look at these examples. These are all problems that happen inside a company. Let's say a brand new competitor with some cool new tech shows up and starts stealing customers from an old, established company. Well, that's a huge risk for that one company, but it probably means nothing to a bank or a drug manufacturer. Or maybe a company just has way too much debt and it's struggling to pay its bills. These are all internal, small-scale problems.
So the message here is really one of empowerment. Unlike those huge, uncontrollable systematic risks, these little micro-level risks are exactly where a prepared investor can find an advantage. And that brings us to maybe the most important tool you have in your entire toolkit.
This right here, diversification. This is your number one weapon against unsystematic risk. It's a word you hear all the time, but sometimes people don't fully grasp what it means. It's not just about owning a bunch of different things. It's about owning the right mix of different things.
So, how do you actually pull this off? How do you build a portfolio that isn't going to get totally wrecked if one company goes under or one industry has a bad year? The answer is diversification. Some people call it the only free lunch in investing. By spreading your money out, you're basically making sure that one bad event in one corner of your portfolio doesn't burn the whole thing down. You're building yourself a financial safety net.
And this is how you do it in the real world. The main idea is to put your money in at least 5 completely different, unrelated parts of the economy. Why? Well, because something that's really bad for a bank might be totally irrelevant to a pharmaceutical company. A crisis in the oil and gas industry might have zero effect on an IT company. By spreading your bets across all these different fields, you're isolating the risks.
Now let's look at a brilliant, real-world example of this at work. When the price of crude oil drops, a company that pulls oil out of the ground, like Reliance, is going to make less money. That's a loss for them. But what about a company like Barrett Petroleum? They use crude oil to make their products. For them, a lower oil price means their costs just went down, which could mean bigger profits. See? If you own both, the loss in one can be canceled out by the gain in the other. Your portfolio stays nice and steady.
Here's another perfect example of the same idea. Let's say the value of the local currency, the rupee, falls. Well, if you're an exporter selling goods overseas, that's amazing news. Your products just got cheaper for foreign buyers, and you're making more rupees for every dollar you earn. But if you're an importer who has to buy goods from other countries, it's the exact opposite. Things just got a lot more expensive for you. So again, if you invest in both an exporter and an importer, you've protected yourself from those currency swings. You've literally used diversification to create stability out of risk.
Okay, we've gone over the theory, we've talked about the battlefield terrain and the different opponents you might face. Now, let's boil all of this down into a simple, clear set of rules. Think of these as your marching orders for getting into the market the smart way. First off, like we just talked about, spread your money across at least 5 different sectors. Second, a great shortcut to diversification is to look at index funds. They basically hold a little piece of the whole market, so you're instantly diversified. Third, make it a habit. A systematic investment plan, or SIP, just means you're investing a set amount automatically every month. It's a great way to be consistent. And last, be careful with those super volatile stocks. In the finance world, they measure this with something called beta. A high beta stock can give you huge wins, but it can also give you massive losses, so tread carefully. And now we get to what is probably the single most important rule of all. This one is non-negotiable. You have to burn this into your brain. Never, ever, ever invest with borrowed money. The stock market is risky enough as it is, but when you use a loan to invest, you are multiplying that risk like crazy. A small dip in the market could completely wipe you out and leave you deep in debt. Only invest money that you can truly afford to lose. This is the absolute foundation of smart, responsible investing. So, let's wrap this up. Risk isn't something to run away from. It's just a set of factors. Some you can control, some you can't. By understanding that difference and by using the incredibly powerful strategy of diversification, you stop being just a passenger hoping for a good outcome, and you become the pilot of your own financial future. You've studied the battlefield. You have the map. The only question left is, are you ready to take command?
You know, it's so easy to feel completely lost in all the chaos of the stock market, right? Well, you are definitely not alone. In this explainer, we're going to cut right through all that noise. We're going to build a simple but really powerful playbook for what I call patient investing. Let's dive in.
All right, let's start with a quote from, well, the master himself, Warren Buffett. He said, "The stock market is a device for transferring money from the impatient to the patient." And honestly, this one sentence just perfectly sets the stage for everything we're talking about. It's not about being the smartest person in the room. It's really all about having the right mindset, the right temperament.
So that Buffett quote, it really boils down to two very different kinds of people, two core mindsets. You've got the impatient investor, right? They're thinking in days, chasing hot tips, totally driven by emotion. And then you've got the patient investor. They think in years, they do their homework, and they stay calm and disciplined. This whole guide is about helping you become that second person.
Okay, so here's a quick look at our roadmap. We'll start with the patience principle, then get into the do's and don'ts. We'll explain investing timelines, talk about building your portfolio, and wrap it all up with a final takeaway.
All right, Section 1, the patience principle. Let's really dig into understanding this core concept.
So why do we keep talking about patience? Why is it like a superpower? Well, look at this. We're talking about a potential annual return of around 22 to 23%. Now, what does that actually mean for you? It means you could double your money in just 3 to 4 years. That's the incredible power of compounding at work. But listen, this is a reward for discipline. It's not like winning the lottery.
Okay, let's move on to Section 2, the do's, your playbook. This is all about the habits of successful investors.
So let's be honest for a second. What does it really take to succeed in the market? There's the saying, before you can earn, you have to learn. And it's so true, but people always seem to forget it because they're in such a rush. So what kind of commitment are we talking about? Can you just, watch a few videos over a weekend and become a pro? Not exactly.
Now take a look at this. Think about it. We all just accept that becoming a doctor takes 5+ years. An engineer? 4 years. A chartered accountant? 4 or 5 years. It's a serious commitment. So why on earth do so many people think they can master investing with a few clicks? The reality is, becoming a successful investor, well, it takes that same level of dedication, about 4 to 5 years of serious learning.
So, what does that learning process look like? It's really a simple, disciplined cycle. Step 1 is to learn. Get that education first before you jump in. Then you implement, and this is key. You start with a small amount of money, something you're okay with losing, just in case. And finally, you grow. As you start to see some profits, you gradually, and I mean gradually, increase the amount you're investing. You build from a position of strength, not guesswork.
And this is a big one. It's absolutely crucial to align your investments with your actual life goals. The stock market is not a magic wand you can wave at every financial problem. For short-term goals, like, say, a down payment on a house next year, you should never put that money in stocks. It's just too volatile. For those medium-term goals, a mix is smart. But for the really long-term stuff, 5 years out or more, that's where equity, stocks really shine.
Which leads us to what I call the 5-year rule. This is so simple, but it is so powerful. Here it is. Only invest money in the stock market that you know for a fact you won't need for at least 4 to 5 years. This rule just automatically forces you to have that patient mindset. It's your safety net. It prevents you from ever being in a position where the market dips and you're forced to sell at a loss because you suddenly need that cash.
All right, Section 3 is Investing Timelines Explained. Let's really get clear on what long-term actually means, because people throw that term around a lot.
So, look at this spectrum. It really lays it all out. Way over on the left, you've got stuff like scalping, where people are in and out of a trade in seconds. Then you have intraday trading within hours, swing trading over a few days, and as you move to the right, the timeline gets longer. Now, where do we as patient investors live? We live way over here on the right side. We're talking about holding for 9 months, a year, 5 years, even longer. That is true long-term investing.
Okay, on to Section 4, the don'ts and common traps. It's just as important to know what not to do. This is how the impatient investor loses money.
Okay, this first one is a classic mistake. It's called downward averaging. You might have heard the phrase,
trying to catch a falling knife. That's exactly what this is. An impatient person sees a stock's price dropping and thinks, "Ooh, it's on sale, time to buy more." But the patient investor stops and asks the most important question: why is it falling? Is the company in trouble? You have to do your homework before you even think about buying more.
This next one is a hard and fast rule. Never, and I mean ever, take out a loan to invest in stocks. Just don't do it. Why? It's simple, really. The interest on that loan is a certainty. You have to pay it every single month, no excuses. But the returns from the stock market, that's just a probability, and it's a long-term one at that. You're setting up a guaranteed loss against a potential gain, and that is a recipe for disaster.
So, you need to be on the lookout for these red flags, both in other people and in yourself. Are you acting on hot tips without doing your own research? Are you making decisions because you're scared or because you're getting greedy? And are you putting all of your investment money into the stock market? Any of these are huge warning signs that you're acting like an impatient investor.
All right, Section 5, building your portfolio. This is about the art and science of diversification. So if you're not supposed to put all your money in one place, how exactly do you build a strong portfolio?
You've heard this a million times, I'm sure. Don't put all your eggs in one basket. It might be the oldest saying in the book when it comes to investing, but it is absolutely the most important principle for managing your risk. It's simple, but it is profoundly true.
So how do we turn that old saying into a real plan? Here's how. First, you research and find several different promising industries, not just one. Second, you build a portfolio of maybe 10 to 15 different stocks across those different sectors. And third, you monitor how it's doing periodically. Notice I said periodically, not every single day. This way, if one company or even one whole industry has a bad year, your entire portfolio doesn't sink.
Yeah, let's talk a bit more about monitoring. This does not mean staring at your phone, watching the little lines go up and down all day. That will drive you crazy. It means doing a strategic checkup, maybe once a quarter or a couple of times a year. You look at your investments, you see what's working well, what's consistently losing, and you make calm, strategic decisions. It's a checkup, not an obsession.
Okay, we've covered a lot of ground, so let's get to our last section. Number 6, your final takeaway. This is all about what it really means to become the patient investor.
So here it is. This is your playbook, your personal checklist. I want you to think of this as a commitment you make to yourself. I will commit to learning. I will start small. I will align my strategy with my goals. I'll invest for the long haul, diversify my stocks, do my own research, and, maybe the hardest one, I will remain disciplined and unemotional. This right here, this is what separates real success from just gambling in the stock market.
So, at the end of the day, it's one thing to know all these rules, right? It's another thing entirely to actually put them into practice. So my question for you is this: knowing what you know now, what is the very first small step you're going to take on your journey? What's it going to be?
You know, so many of us are looking for that hot stock tip, right? That one investment secret that's going to change everything. But what if the real secret isn't a secret at all? What if it's just a different way of thinking? Before we get into any strategies, we've got to talk about the foundation. We have to talk about taking ownership of your money right here in your head. So let's dive in.
This right here is the absolute bedrock of everything we're talking about today. It's simple, it's direct, and honestly, it's non-negotiable. Think about it. Nobody, and I mean nobody, is ever going to care about your money as much as you do. Not your financial advisor, not your buddy from college. Nobody. It all starts and ends with you. And hey, that's not supposed to be scary. That's supposed to be empowering.
So here's the roadmap for our time together. First, we're going to really lock in that idea of responsibility. Then we'll get practical, talking about writing down your goals and finding your focus. After that, we'll dig into why learning this skill is so much better than just chasing tips. Then we'll cover the superpower of long-term thinking, and we'll wrap it all up by talking about an abundance mindset. Each step builds right on top of the last one. Okay, let's start with the CEO of your finances, and that's you. Let me be blunt. You are, without a doubt, the best person for the job of managing your financial future. This whole session is really about getting your head right for that journey. It's about you moving out of the passenger seat of your own life and getting behind the wheel, hands at 10 and 2, ready to drive.
All right, now for our first real actionable step.
We all have these big ideas about money kind of floating around in our heads, right? That dream vacation, buying a house, retiring without a care in the world. But here's the thing about a goal that just stays in your head. It's not really a goal, it's just a wish. The first move to make it real? Get it out of your head and onto a piece of paper.
So seriously, take a second. What are they? And I don't mean something vague like, oh, I want to be rich. What does that actually mean for you? How much money? By what date? Getting crystal clear on this stuff, well, that's the first step to actually being in control. And breaking it down like this really helps organize those thoughts. Because not all goals are created equal, right? Taking the family on a nice holiday this year, that's short term. Saving up for your kids' college education, that's more of a medium-term thing. And then you have the big one, retirement, classic long-term goal. When you categorize them like this, the future suddenly seems a lot less overwhelming and way more doable.
And this is the part that so many people miss. The simple act of writing something down. It does something to your brain. It commits you in a way that just thinking about it never, ever will. It makes you get specific. And remember, this plan isn't set in stone. It should be a living, breathing document that you check in on and adjust as your life changes. It's your personal roadmap.
And if you're still not totally convinced, just look at this number. A study in Fortune magazine years ago found that people who had written investment plans ended up with, on average, 5 times more money in retirement than people who didn't. Let that sink in for a second. 5 times more. So yeah, writing this stuff down isn't just about feeling organized. It has a huge real-world impact on your bottom line. Okay, so you've got a plan. What's next? Focus. You see, without focus, you can have a great income and still end up in a world of financial trouble. It's not about how much you make, it's about where your attention and your money goes. And let me tell you 2 quick stories that just nail this point perfectly. So our first story is about a woman in the IT field. Good job, solid salary, making about 400,000 rupees a year. And yet, she was somehow drowning in 15 lakhs, that's 1.5 million rupees of debt. How in the world does that even happen? It happens because of a total, complete lack of financial focus. Her focus wasn't on her plan, her future, or her investments. It was on stuff. Compulsive shopping for expensive clothes, more than 24 pairs of sandals, 15 watches. And here's the real kicker. Most of it she never even used. Her attention was on consuming, and the result wasn't wealth, it was a crushing mountain of debt.
And believe me, this isn't some rare, isolated problem. Our second story is about a homeopathic doctor also deep in debt. His particular weakness wasn't clothes, though. It was technology. This guy's focus was on always having the latest and greatest gadget, the newest phone, the fastest laptop. He even had 4 different iPods. But it's the same story, isn't it? Just like the IT professional, he hardly used any of it. In both cases, their focus determined their financial reality, and their focus was squarely on spending, not on investing. So, what's the fix for this kind of scattered focus? Well, you shift your attention away from chasing hot tips and start building an actual skill. This, my friends, is where you really, truly take back control. Relying on someone else's tip is like a quick sugar rush. It feels good for a second, but it often leads to a crash. I mean, just look at the difference here. On one side, you're blindly trusting other people who might have their own agendas. You're dependent. It's a short-term fix. But on the other side, you're taking responsibility. You actually understand why you're making a decision. It's a skill that pays you back for the rest of your life. It's really a choice between dependency and empowerment. Pretty clear which one you want to choose.
And let's get really clear on this conflict of interest thing. All it means is that the person giving you advice might make more money if you follow their advice. A mutual fund guy is probably going to tell you to buy mutual funds. A real estate agent is going to tell you to buy property. It doesn't mean their advice is bad, but it does mean it isn't neutral. And understanding that difference is absolutely crucial. I love this analogy because it's so perfect. Your job, your salary, that's the water pouring into your financial jar. But if you don't know how to invest properly, well, that jar is just full of holes. The water comes in and it goes right back out. Learning the skill of investing, that's how you plug the leaks. So the wealth you're creating actually stays with you and has a chance to grow. We live in a world that is obsessed with right now. Get rich quick, instant results. But creating real, lasting wealth, that's a marathon, not a sprint. It takes patience. And that brings us to the next massive piece of this mindset shift, learning to think long-term. The best way I know to think about this is like planting a tree. You plant a small seed today. That's your initial investment. You don't go digging it up every single day to check on it, right? No.
You water it, you give it sun, and you let it be. In 5 years, you've got a sprout. In 10 years, it's a real plant. But if you have the patience to wait 20 years, or even more, you end up with a massive, fruit-bearing tree that can provide for you for a lifetime.
So how do you actually start doing this? First, you've got to stretch your time horizon. Start thinking in 5, 10, 20-year chunks. Second, become a learning machine. The faster you learn, the smarter your actions will be. Finding a good mentor can shave years off your learning curve. And finally, and this is maybe the most important part, you have to take consistent action. Small, regular steps, taken over a long time, that is how fortunes are built. This brings us to our last stop, and honestly, it might be the most powerful mindset shift of them all. It's about moving away from a scarcity mindset, that feeling that there's never enough, and moving toward a mindset of abundance. And strange as it might sound, one of the fastest ways to get there is by giving. See, when you start to give, whether it's donating to a cause you care about or just giving your time to help someone out, something really profound happens in your brain. You stop seeing money as this precious thing that has to be hoarded and protected out of fear. Instead, you start to see it for what it is, a tool to make a positive impact. And when you make that shift from scarcity to abundance, it's funny, it somehow opens you up to receive more in return.
So let's just wrap it all up. This is it. This is your blueprint. Number 1, take full responsibility. 2, write down your goals. 3, focus on investing, not just spending. 4, learn the actual skill. 5, think in decades, not days. And 6, give back to foster that abundance mindset. These 6 things, they're the foundation for everything else.
Okay, we have covered a ton of ground, but you know what? All this information is totally useless if you don't do anything with it. So I'm going to leave you with this one simple question. Not tomorrow, not next week. What is the one single thing you will do today to start owning your financial future? Will you finally write down that goal? Will you go buy a book on investing? Decide on one thing and do it, because that's where the real work and the real change begins.
Let's be honest. Have you ever opened up your brokerage account and just stared, completely overwhelmed by that endless list of companies, wondering, where on earth do I even start? Well, you're in the right place. Today, we're going to crack open a simple but, incredibly powerful secret. It's a filter that helps you slice right through all that noise and zero in on companies with real quality.
So here's the game plan for today. First, we'll talk about the investor's dilemma, something I'm sure we've all felt. Then we'll get right into the 10-year test itself. We'll break down why longevity is such a big deal, look at a few companies that are perfect examples, and then wrap it all up with the one golden rule you need to remember. Sound good? Let's jump in.
All right, let's get right to it. First up, the investor's dilemma. And the subtitle here says it all, really, the paralysis of choice.
This is the big one, isn't it? You've made the decision, you're ready to invest, you log in, and bam, you're hit with this just wall of ticker symbols, thousands of names. It can feel like you're standing at the bottom of a mountain for sure. And look, we're not talking about a handful of options here. When you look at exchanges like the National Stock Exchange or the Bombay Stock Exchange, you're talking about thousands upon thousands of listed companies. It's just a sea of choices. And let's be real, not all of them are going to be winners. Trying to analyze every single one, that's not just hard, it's impossible. So the real question is, how do you even begin to filter them down?
And that's where this little secret comes in. This brings us to the solution, the 10-year test. Now, don't think of this as some complicated financial formula you need a PhD to understand. Nope. Think of it as a really simple but really powerful filter for quality.
The great Benjamin Graham, Warren Buffett's mentor, the father of value investing, he really hit the nail on the head. He said, investment is most successful when it is most businesslike. And what does that mean? It means you're rational, you're disciplined, you have a clear set of rules. And honestly, the 10-year test is the perfect example of that kind of business-like thinking.
So what exactly is this test? Let's break it down plain and simple. The 10-year test is basically a rule of thumb. It says that a company should have been in the same business for at least a decade, 10 years, before you even put it on your watch list. That's it. That's the rule. So we're not talking about the latest, flashiest startup here. We're talking about proven, time-tested endurance.
Okay, but why 10 years, right? What's the magic in that number? Well, that brings us right to our next point, why longevity matters. And the short answer, It's all about surviving the cycles. Think about it. A decade is a really long time in the business world. It's more than enough time for a company to get seriously tested. Because the economy is never a smooth ride, is it? It's a roller coaster. You've got boom times, sure, but you've also got recessions, huge market shifts, maybe even a depression. So if a company is still standing, still doing its thing in the same business after all that, well, that tells you something really, really important about how durable it is. And that track record, it gives you, the investor, some very real advantages. First off, it means they've been through those economic ups and downs we just mentioned. That's proof of resilience. It shows stability. But what's really crucial is that it gives you a visible history. You have actual data to look at. Their performance is all out there in the open. It's much easier to track and analyze, and that just removes a huge amount of the guesswork from your decision-making.
Okay, so that's the theory. It sounds good, right? But does it actually hold up in the real world? Let's take a look. Let's check out some profiles in resilience. Real companies that have absolutely smashed this 10-year benchmark. Let's start with a giant in the tech world, Infosys. I mean, these guys were founded way back in 1981. That's over 4 decades in the business. Just think about everything that's happened in tech since then. They've not just survived, they've thrived through massive shifts. The dot-com bubble bursting, the move to cloud computing, you name it. And all of that history, it gives you this incredible wealth of data to see how the company's leadership handles change. All right, next up, let's switch gears completely. Let's talk about Dabur India. We're moving into the world of fast-moving consumer goods. Now, Dabur's history goes all the way back to the 1800s. It's incredible. Their products, the ones based on Ayurveda and natural health, they are staples in millions of homes. This just goes to show a business model that isn't a fad, it's woven into the very fabric of the culture. It's proven its stability through good times and bad for literally generations. Okay, how about retail? Let's look at Bata India. What do? They make and sell shoes. It's a fundamental consumer need, right? And their huge network, we're talking over 1,500 stores. That didn't just pop up overnight. That massive physical footprint all over the country, that's the proof right there of their longevity and how deep their roots go in the market. It's why they're a household name that people know and trust. And for our last example, let's touch on a really critical sector, banking. HDFC Bank. They were incorporated back in 1994, and they were actually one of the very first to get a private banking license from the RBI. And look at them now. They've grown to become the largest private sector bank in the country. In banking, trust and stability are everything, and HDFC has weathered global financial crises and economic downturns, proving the resilience of their business for almost 30 years now. Okay, so we've talked about the problem of too much choice. We've got our simple solution, we've seen why it works, and we've looked at some rock-solid examples. So what's the bottom line? That brings us to our last section, the golden rule. If you remember one thing from this whole explainer, this should be it. So here it is, the big takeaway. And you'll see, it's not complicated at all. If you are serious about getting a good return from the stock market, your very first filter should be this. Look at the company's history for at least the last 10 years. Make sure it's been doing the same thing, proving it knows how to survive and thrive, before you even think about investing your hard-earned money. And that, my friends, is the 10-year test in a nutshell. But before we wrap up, I want to leave you with a little homework, a question to think about. Just look around you, in your home, in your daily routine. Which companies do you interact with every single day? Which of them are these enduring, long-lasting businesses that would just sail through this 10-year test? You might just be surprised how many great potential investments are hiding right there, in plain sight. Thanks for joining me.
All right, let's dive into something that I think is one of the most important yet simplest secrets for any serious value investor. We're talking about a single rule, a filter that can seriously upgrade your investment choices and help you find those companies that are truly built to last.
The legendary John Bogle really hit the nail on the head with this one. Learning from what other people have already figured out, well, it's just the cheapest education you can get. And that's exactly what this is all about. We're taking a powerful lesson from some of the best in the business so you don't have to learn it the expensive way.
So here's the game plan. First, we're going to uncover this simple little secret. Then, we'll get into the whole idea of skin in the game and why it matters so much. After that, we'll look at some real-world examples, the proof in the profits. And finally, we'll wrap it all up into one golden rule you can start using right away.
Okay, Section 1. Let's get straight to it. We are on the hunt for one key metric, just a single number that gives you a massive clue about a company's potential for greatness.
So, I want you to think about this for a second. If you could only know one thing about a company's leadership to tell you how committed they are, what would you look at? What single number screams, "We believe in this company's future"?
And there it is. It's that simple. The secret is to only focus on companies where the founders, the promoters, the people who started it all and are still driving the vision, hold a majority stake. We're talking more than 51%. It sounds almost too simple, right? But trust me, as you're about to see, this little filter is an absolute game changer.
So, what's the magic behind this 51% number? Well, it all boils down to one powerful idea: having skin in the game. It's about making sure everyone's interests are aligned, that the motivation is pure, and that their belief in the business is real.
Think about it. Nobody on earth knows that company better than the person who founded it. When they own most of it, their personal wealth rises and falls with the company's stock. They aren't just working for a paycheck, they're working day and night because their legacy, their fortune, their whole vision is wrapped up in that business. Their success is your success.
And this right here, this lays it all out perfectly. On one side, you've got high ownership. That means their wealth grows right alongside yours. They are driven to build for the long term. And hey, if you see them buying more stock, that's about the best signal you could ever ask for. But on the other side, if their stake is low, or worse, they're selling, that's a huge red flag. It might mean they're losing faith or their motivation is just gone.
Okay, so the theory makes sense, but talk is cheap, right? Let's look at the numbers. We're going to check out 3 real companies that show just how powerful this simple rule can be when it comes to generating some seriously impressive returns.
First up, Burger Paints. Now, check this out. The promoters hold a whopping 75% of the company. That is a massive statement of belief. And the result of that commitment? A fantastic 28% compounded annual growth rate over the last 10 years. That's your average return every single year.
I mean, just look at this visual. It says it all. 3/4 of the entire pie belongs to the promoters. That is an unshakable, undeniable faith in where the business is headed. They don't just have skin in the game, they practically own the whole stadium.
So what does a 28% return actually mean for you? Well, it means your investment would double in just about 2.5 years. That is the kind of wealth-building power you get when you have deeply committed leadership at the helm.
Okay, next example. Havells India, big name in electrical equipment. And what do we see? Same story. The promoters own almost 60% of the company. And the performance? Another incredibly strong 26% compounded annual growth rate over the decade. See a pattern here? And again, the visual just makes it crystal clear. The promoter has a solid, controlling majority. That ensures their long-term vision is what guides the company, not some short-term pressure. They are all in, right there with the shareholders.
And at that 26% clip, your money in Havells would have doubled in just under 3 years. The evidence keeps piling up. High promoter ownership lines up with fantastic, market-beating returns.
All right, for our last example, let's look at SRF Limited. Now this one's really interesting. Look at that promoter holding, 50.7%. They are just barely over our 50% line. So what about the performance? Hold on to your hat, an absolutely staggering 49% CAGR over the last 10 years. So even with what looks like a slim majority, that 50.7% is all it takes. It's the magic number. It proves that crossing that 50% threshold is the critical factor that keeps the founder in control and fully committed.
Let's just pause on this for a moment. A 49% annual return is just off the charts. At that rate, you're doubling your money every 1.5 years. This is what can happen when a founder with real skin in the game is firing on all cylinders. It's incredible.
So when you put them all side by side like this, the proof is just undeniable. You've got SRF leading the pack with a mind-boggling 49%, Burger Paints with a solid 28%, and Havells with 26%. 3 different companies, 3 different industries, but they all share that one crucial DNA, high promoter ownership, and the incredible returns that followed.
Okay, so we've looked at the logic, we've seen the hard evidence. Let's boil this all down to one simple, powerful takeaway that you can use to make your investing journey a whole lot smarter.
And here it is, the golden rule. If you're looking for safe, long-term growth, a great place to start is to make sure the promoter's holding is at least 50%, and ideally over 51%. Now look, is this a 100% guarantee of success? No, of course not. Investing has no guarantees. But this is a powerful first filter.
It's a quick check to make sure the people in charge have just as much, if not more, to gain from success as you do.
So, the next time you're looking at a new investment idea, before you get lost in the spreadsheets and the analyst reports, just ask yourself this one simple question. What's the very first number you're going to check? It should probably be the promoter's stake. It might just be the most important piece of data you find. Thanks for tuning in.
You know, every single one of us who invests is really looking for the same thing, right? We're hunting for that one company, that one special stock that can truly change the game for our portfolio. It's not about the latest fad or what everyone's talking about online. It's about finding real, solid value. And today, we're going to pull back the curtain on a simple but incredibly powerful secret to help you spot these companies long before the rest of the market catches on.
This quote from Robert G. Allen just nails it. Think about it. We're all taught to save money. And of course, that's important for a rainy day. But has anyone ever gotten truly wealthy just by letting cash sit in a savings account? Exactly. Building real, generational wealth requires a completely different mindset. It means putting your money to work in things that can grow and grow big.
Okay, so that's the million-dollar question, isn't it? If a savings account isn't the answer, what is? I mean, you look at the market and there are thousands of companies out there. How in the world are you supposed to pick the winners? It feels like looking for a needle in a haystack. But what if I told you there's a magnet you could use, a way to filter out the noise and zero in on what really matters?
All right, enough theory. Let's make this tangible. We're going to look at a real company that absolutely crushed it. A perfect case study for this kind of incredible growth. Eicher Motors. You might know them. They're a huge player in the Indian auto industry.
Now just look at these numbers for a second. In 2012, you could pick up a share of Eicher for about 150 rupees. Fast forward just one decade to 2022, and that same share was worth around 3,600 rupees. That's not a typo. That's a 24 times increase. That's not just growth, that's a total transformation.
So what does a 24 times increase look like on an annual basis? Well, it works out to a mind-blowing 37% compounded annual growth rate. Let me put that into perspective for you. At 37% a year, your investment doubles in less than 3 years. It doubles again in another 3. That's the kind of performance that can fundamentally change your life.
And that right there, that's the dream. But looking back is easy, right? Hindsight is always 20/20. The real question is, what were the signs back in 2012? Was there a secret, a clue that Eicher Motors was broadcasting that pointed to this massive future? Well, yes, there was. And we're about to break it down.
And here it is. This is the heart of it all. The secret behind these powerhouse stocks is something we're calling the 20% growth secret. And it all boils down to one key idea: finding companies that show consistent, high-quality growth in their top line.
So, just to make sure we're all on the same page, what is the top line? It's actually super simple. It's just a company's total sales, all the money that comes in the door from customers. And it gets its name because if you look at a company's financial statements, the profit and loss sheet, it's literally the first line, right at the very top. Simple as that.
So here's our first big filter. This is rule number 1. We are looking for companies whose top line, their total revenue, is growing by at least 15%, ideally 20%, every single year, year after year. A company that pulls that off is sending a powerful signal. It's telling you it has a product people want, and it's gobbling up market share.
But wait a minute. This is where we need to put on our detective hats. Seeing a 20% jump in revenue looks fantastic on a spreadsheet, but is all growth really good growth? The answer is a hard no. Before you get too excited, you have to dig a little deeper and ask a couple of really important questions.
And this brings us to the first catch. You have to make sure you're looking at real growth. You have to figure out how the company is making more money. Are they actually selling more products to more people, or are they just jacking up the prices on the same old customers? There's a huge difference.
This simple example with the pens shows it perfectly. Look at the column on the left. Sure, revenue is up by 200 rupees. Looks good, right? But look closer. They sold the exact same number of pens. Their business didn't actually grow, they just charged more. Now look at the right. Not only did they charge a bit more, they also sold 20 times more pens. That is genuine growth. It shows increasing demand, and that's the sign of a healthy, expanding business.
Okay, so check number 1 is making sure they're selling more units. But there's a second, equally important catch. You need to be sure the money is coming from the right place. Is this growth coming from their main business, or is it from some weird one-time event that makes the numbers look good? And the term for that is operational income. It's just what it sounds like.
income from operations. It's the money a company makes doing the thing it's supposed to do. A car company selling cars, a software company selling software. This is the lifeblood of the business, the part that's repeatable year after year.
And this makes it crystal clear. On the left, you've got revenue coming from the core business. It's sustainable, it's predictable, it's a sign of real success. But on the right, you have non-operational income. Maybe the company sold a building or a piece of land. Yeah, that brings in a ton of cash and makes that year's revenue look amazing, but they can't sell that building again next year. It's a sugar high. You always want to focus on the left side.
So, now that we have our two catches, let's go back to where we started. Let's revisit Eicher Motors. How does this framework explain that incredible 24-fold growth we saw? Well, when we apply these two simple tests, the mystery completely disappears.
So what was happening under the hood at Eicher during that incredible decade? Well, first, it passed the real growth test with flying colors. It wasn't just raising prices, it was selling more and more motorcycles and trucks year after year. And second, it passed the core business test. All that growth was coming directly from its main job, making and selling vehicles. It was the perfect storm of real operational growth.
So, when you combined that initial 20% top-line growth filter with our two crucial checks, real unit growth and core business income, you end up with a simple yet incredibly powerful principle. Think of it as your golden rule for investing.
Here it is. The scripts that will never disappoint you are those whose sales increase a minimum of 20% every year. Now I know, that's a bold statement. Never disappoint, but it holds true if, and this is the most important part, if you've already confirmed that it's the right kind of growth. It's got to be real growth from the core business.
So, to make this as practical as possible, here's your checklist, a simple 3-step test you can apply to any company you're looking at. Step 1. Is that top-line revenue growing by at least 20% a year? Step 2, is that growth coming because they're selling more stuff? And step 3, is the money coming from their main core business? If you can get a solid yes to all 3 of those, you might be onto something very, very special. This little 3-step check is your secret weapon. It's a powerful way to cut through all the market noise and focus on what truly drives long-term value. So, I'll leave you with a question to think about. Take a look at the companies you own, or the ones on your watch list. How many of them actually pass the 20% golden rule test? The answer just might surprise you.
All right, today we are pulling back the curtain on one of the most powerful and, beautifully simple secrets for finding companies that are actually worth your time. We're going to cut right through all the noise and the hype and focus on one single crucial number that really tells you everything you need to know about the health of a business. But before we get to that secret rule, we have to start with a little warning. See, there's this fundamental trap, a psychological trap that catches so many investors. It doesn't matter if you're brand new or a seasoned pro. It's a way of thinking that just clouds your judgment, and honestly, it almost always leads to some pretty expensive mistakes. And this quote from the absolute legend, Sir John Templeton, just nails it. It's different this time. Man, those words, they are a timeless warning against ditching what we know works just to chase after the latest, hottest trend. Believing that the old rules suddenly don't apply anymore, that is one of the costliest mistakes you can ever make in investing. The secret we're about to dive into, well, it's built on a principle that has stood the test of time through every kind of market you can imagine.
So, okay, if we're throwing out the idea that it's different this time, what are we left with? What should we really be focused on? Well, let's just get back to the absolute basics and figure out the one thing that truly drives a company's value over the long haul.
It all comes down to this right here, net profit. You've heard people talk about the bottom line, right? Well, this is it, literally. It's that final number on a company's profit and loss statement. To put it simply, it's all the money that came in the door minus all the money that had to go out. It's what's actually left.
The absolute best way to think about profit is as the lifeblood of a business. Seriously, just like you or me, a company just can't survive without it. It could have the most amazing, revolutionary product, a marketing team full of geniuses, but if it's not actually making a profit, believe me, it is on a countdown to disaster.
Let's just be crystal clear on why this is so important. A business that isn't profitable is, well, by its very definition, it's unsustainable. It's just burning through cash. The whole point of being in business in the first place is to make a profit. So when you find a company that isn't just profitable, but consistently profitable, year after year, that is one of the strongest signals you will ever find of a healthy, well-run, and growing company.
Okay, so we've established it. Profit is king. But that's only half the battle. The real question is, how much profit growth should we be looking for? And this is where we go from a general idea to a very specific, actionable rule. This, my friends, is the investor's secret.
After looking at thousands and thousands of companies, savvy value investors have really zeroed in on a specific benchmark. It's a target that separates the pretty good companies from the truly great ones. So, what is that golden rule? 20%. That's it. That's the magic number. Now, I know it sounds demanding, but it's an incredibly powerful filter for finding those exceptional businesses that are capable of real, sustainable, long-term growth.
So here's the deal. We aren't just looking for companies that are profitable. We're on the hunt for companies that are growing that profit year after year by at least 20%. This isn't about a one-time fluke. It's about sustained, compounding growth, where it matters most, the bottom line.
And here's the great part. You can apply this rule yourself. It's a really straightforward process. You just pull up a company's financial statements for the last decade or so. You're not looking for one good year, you're looking for a pattern, a trend of consistent increases, year after year. And that powerful 20% minimum, that's the benchmark you're measuring against.
Now, a rule is only as good as its results, right? It's one thing to talk about a 20% growth target in theory, but does it actually help us spot winners out in the real world? Well, let's put it to the test.
We're going to take a look at 3 completely different companies, operating in totally different industries, that all pass this tough test with flying colors. This is really going to show you just how versatile and powerful this principle is.
Just take a look at this data. What's so amazing is the sheer diversity here. You've got Balaji Amines in specialty chemicals, HCL Tech in global IT, and Ajanta Pharma in pharmaceuticals. You couldn't get much more different. And yet, look at their 10-year compounded profit growth. 27%, 23%, and 25%. Every single one of them just sails right past our 20% benchmark.
This chart really paints the picture, doesn't it? We're looking at sustained, powerful performance over a full decade. This isn't a one-hit wonder or some flash in the pan. This kind of long-term growth is what happens when you have solid business fundamentals, excellent management, and a really strong position in your market.
So first up, we've got Balaji Amines. They're a huge player in the specialty chemicals world. Now, they make things with names like methylamines and ethylamines. Sounds pretty technical, right? But what it really means is they create the essential building blocks for other massive industries, like pharmaceuticals and agriculture. Their incredible growth comes from being a critical, can't-do-without-it link in that supply chain.
Next, HCL Tech. This company is a true global IT giant. They operate on a massive scale. We're talking 46 countries, doing everything from complex IT solutions and managing infrastructure to cutting-edge research. Their amazing performance proves that this 20% rule isn't just for some small, nimble startup. It absolutely applies to huge, established leaders of industry too.
And our third example is Ajanta Pharma. They are a super-focused pharmaceutical company. They don't try to be everything to everyone. Nope. Instead, they excel at developing and making specialty drugs with this laser focus on quality. Their success is just a perfect example of how having deep expertise in a high-demand field can translate directly into powerful, sustained growth on the bottom line.
Okay, so we've seen the rule and we've seen the real-world proof. But now we got to connect the dots. What's the ultimate takeaway here? How does all of this connect to what every investor really cares about, the value of their stock?
We've already established that these companies are phenomenal profit-growing machines. But how does that actually connect to their value as an investment? Well, there's one final fundamental principle that ties this whole thing together with a nice little bow.
This is it. If you remember one thing from our time together, let it be this. In the long run, the market isn't a popularity contest, it's a weighing machine. And the thing it weighs more than anything else is profit. A stock's price will, over time, always chase the trajectory of its net profit. It's almost like a law of physics for investing. In other words, if a company can reliably and consistently grow its profits by 20% a year, it is highly, highly likely that its stock value is going to follow a very similar upward path over time. All the day-to-day market noise, the headlines, the drama, it doesn't really matter. What matters is the fundamental engine of the business, its power to grow that bottom line.
So there you have it. That's the secret. It's not about some complex algorithm or getting hot tips. It's about focusing on the lifeblood of a business, its net profit, and looking for strong, consistent growth.
So the question I'll leave you with is this. Now that you know the secret, go take a look at the companies you follow, the ones you're interested in. How many of them actually pass the 20% test?
You know, trying to find a truly great company to invest in, it can feel like you're searching for a needle in a haystack the size of a planet. I mean, there are thousands upon thousands of companies out there, so where do you even start? How do you cut through all that noise? Well, today we're going to build a tool, a really powerful filter to do just that, to help you zero in on exactly what you're looking for. All right, let's get into it.
So here's the plan for today. First, we're going to get our heads in the right space, a little unlearning to do. Then I'll show you a fantastic free tool that I use all the time. We'll walk step by step through building your first screen. I'll give you 4 of my favorite recipes you can plug in right away, and then we'll talk about the most important step of all, what comes next.
Okay, before we even touch a keyboard or look at a website, we have to start right here with our mindset. It is so easy to just stick with the big names you already know, or worse, chase after some hot tip you heard somewhere. But to find those hidden gems, the truly great opportunities, we kind of have to unlearn those habits and build a more systematic way of thinking from the ground up. And this quote, man, it just nails it, right? It's all about humility. It's about being open to the idea that maybe, just maybe, there's a better way to do this than just guessing or following the crowd. This idea is the foundation for everything we're about to do. So, keeping that in mind, let's get our hands dirty. All right, enough of the philosophy. Let's move into action. I'm going to show you the exact tool that lets us put this systematic, data-driven approach to work to actually find these great companies. The tool is called screener.in, and I'm not just recommending some random website. This is what's in my personal toolkit. It's powerful, it's packed with data, and maybe best of all, it's free. Honestly, for any serious investor who wants to look at the real numbers behind a company, this is one of the best things out there.
And getting started is super simple. First things first, just open your browser and go to the website, screener.in. Once you're there, take a minute to create your free account. Just a login and a password. This is important because it lets you save the filters we're about to build. You can even pause this right now and get that done. I'll wait.
Okay, you got your account all set up? Perfect. Now comes the really fun part. Think of this next step like you're an artist setting up a fresh canvas. We're creating this space where you can paint a perfect picture of your ideal investment by telling the tool exactly what qualities to look for.
So once you're logged in, just look up at that menu bar at the top of the page. Right in the middle, you'll see the word Screens. Go ahead and click that. Then you'll get an option that says Create a new screen. Select that, and boom, you're looking at an empty box. This little box, this is our engine room. This is where we give our instructions. And that brings us to the main event. What on earth do we type into that box? Well, I'm going to give you 4 incredibly powerful sets of instructions. Now, don't think of this as some scary, complicated code. Think of these as recipes. Each one is designed to help you find a different flavor of a high-quality company. Our first recipe is what I like to call the all-around value stock. This is designed to find really solid, well-rounded businesses. We're not just looking for something that's cheap. We're looking for companies with a proven history of growth, profitability, and smart management. It's a fantastic, comprehensive starting point for any value investor. Let's break this down line by line so it's not so intimidating. First, we're telling it price to earning less than industry PE. That's just a fancy way of saying, show me companies that are on sale compared to their competitors. Simple enough. Then we want to see solid growth in both sales and profits, not just last year, but over the last 10 years. Next, we look for high return on equity and return on capital. These are just measures of how good a company is at turning $1 into more dollars. It's a sign of a smart management team. And finally, we want a decent-sized company where the founders, the promoters, still own a big chunk of it, and we want to see very little debt. You just copy and paste this whole block right into that query box. So you see, the real power here is that this recipe isn't just looking for one good quality. It's searching for a combination of good qualities all in one company. It's a filter for businesses that have proven they're strong, efficient, well-run, and financially sound over the long haul. Okay, let's move on to recipe number 2. This one is a lot simpler and has a totally different focus. Instead of digging into the company's internal numbers, we're going to look at how the stock has actually performed out there in the market. We're looking for companies that have a proven track record of making investors money. And look how beautifully direct this is. We're basically just telling the screener, hey,
Show me companies that have returned more than 20% a year for the last 10 years, and 3 years, and more than 10% in the past year. It's a pure search for sustained momentum, for companies that the market just keeps rewarding year after year.
So what we're doing here is finding businesses whose value has been recognized by the market, and not just in some one-off flash in the pan. We want to see it over the long term, the medium term, and even the short term. This is basically a filter for finding proven winners.
Now, for recipe number 3, this one is the definition of simplicity and financial safety. If you're an investor who puts safety above everything else, this filter finds the companies that are basically financial fortresses. They owe nothing to anybody.
And you gotta love how simple a powerful idea can be. The entire query is just 2 words. Debt equals 0. That's it. You type that in, hit enter, and you instantly filter out thousands of companies, leaving you with a list of only those that have rock-solid balance sheets, the ones that fund all of their growth themselves.
And why is this so important? Well, think about it. A company with 0 debt cannot be pushed into bankruptcy by its lenders. It's incredibly resilient when a recession hits and money gets tight. This screen is your go-to for finding some of the absolute safest, most financially stable businesses in the market.
All right, for our last recipe today, we're going big game hunting. This filter is designed to find the titans of industry, the huge, dominant, incredibly profitable companies that you might call blue chip stocks. We're setting the bar really high with this one. First, market capitalization greater than 50,000 means we are only looking at the absolute biggest companies out there. But size isn't everything. We also demand that they be incredibly efficient, with a return on capital employed consistently above 20%. That's a key sign that they are masters at investing their money to make even more money. You combine that with a long history of growing profits, and you've got a screen for finding true quality at a massive scale.
So, what this recipe gives you is a short list of the giants.
These are the big, established, highly profitable companies that are experts at using their capital efficiently. It's a filter for stability, for quality, and for sheer market dominance. Whew, we have covered a lot of ground. You now have the right mindset, you have the tool, and you have 4 powerful recipes to go out and start finding some really interesting companies. But I have to end on what is, without a doubt, the most important point of all. This is not the end of the process. It is just the beginning.
Please let this sink in, but do your research. A screener is a fantastic machine. It spits out a list of companies based on the numbers you feed it. But what it can't tell you is why the numbers are good. It can't tell you if the company has a unique advantage that will last for decades. It can't tell you if the CEO is a genius or a fool. That part, that's your job. This tool gives you candidates. It does not give you conclusions.
So I'll leave you with this. We've just handed you a map of the investment world and a compass to help you find what you're looking for. You have the recipes to start your search for value, for momentum, for safety, for market leadership. The only question left is, where are you going to start exploring first? In the world of investing, we get obsessed with numbers, right? PE ratios, earnings per share, balance sheets, but we often forget about the most powerful force of all, the people actually running the show. Today, we're diving deep into what might be the most overlooked secret in value investing. This is secret number 5, the leadership factor. And let's just kick things off with a massive truth bomb from the legend himself, Peter Lynch. A share is not a lottery ticket. It's part ownership of a business. Just let that sink in for a second. When you buy a stock, you're not just playing a numbers game. You are becoming a part owner. And if you're an owner, wouldn't you want to know exactly who's steering the ship? You bet you would. So here's what we're going to do. First, we'll look beyond the balance sheet. Then I'm going to give you a really powerful tool I call the leadership litmus test. We'll also cover the major warning signs and red flags to watch out for. After that, we'll look at some absolute legends of leadership. And to wrap it all up, I'll give you a simple research playbook so you can put all this into action yourself. Okay, let's get real for a minute. Numbers on a page don't innovate. Spreadsheets don't inspire people. When you invest in a company, you're placing a bet. But you're not just betting on the horse, you're betting on the jockey. A great leader, a great jockey, can guide a company to incredible heights, while a bad one, well, they can run even the best business straight into the ground. That CEO is your most important asset, period. So what are we even talking about when we say leadership? Look, it's not just a fancy title.
We're talking about the person or the team that's really the architect of the company's future. They need to have the vision to see where the industry is going, the integrity to build trust, and the sheer capability to make it all happen. They are the engine. All right, now for the good stuff. How do you actually figure out if a company's leadership is any good? How do you separate the real visionaries from, the empty suits? I'm going to give you a super practical 5-point checklist. I call it the leadership litmus test. And once you start using it, you'll never look at a company the same way again. These are the 5 key areas we're going to investigate. Has the leader built a real competitive advantage? Do they have a clear vision? How long have they been around? What's their background like? And here's a surprising one. Who audits their books? Let's break each of these down. First up, competitive advantage. This is what Warren Buffett calls a moat, a protective barrier around the business. A great leader doesn't just run the company day to day. They're actively digging that moat deeper and wider. Have they built an incredible distribution network? Is their product quality untouchable? Do they have some proprietary tech? That's the work of a smart leader protecting your investment. Next, you've got to ask, where is this ship headed? A leader has to have a compelling vision. What are their big goals? What's the grand plan for the next 5-10 years? You should be able to find this in shareholder letters or interviews. If they can't clearly tell you where they're going, chances are they're going nowhere. Okay, this one's huge. How long has the CEO been on the job? If you see a company that has a new CEO every 18 months, that is a massive red flag. It points to instability, a lack of strategy, maybe even a board that's impossible to work with. You want to see a steady hand, someone who's been there for a while, who has a long-term stake in the company's success. That revolving door in the corner office is a real danger sign. Now, this might sound obvious, but you'd be surprised how many people skip it. You have to do a basic background check. I mean, would you give your money to someone with a history of shady dealings? No way. So why would you invest your money in a company run by someone like that? Just a quick search online for their name, plus words like lawsuit or scandal, can tell you a whole lot. Integrity is everything. And here's a little trick that most amateur investors miss. Check out the company's auditor. Seriously, if they're using a big, reputable accounting firm, that's a good sign. It means they're not afraid of scrutiny. But if they're using some small, unknown auditor, it kind of makes you wonder why. It doesn't prove anything's wrong, but it's definitely a reason to be extra cautious. So we know what good looks like, but just as important is knowing what to run away from. There are some telltale signs that the people in charge might be more focused on themselves than on you, the shareholder. Let's look at a couple of the big ones. First, watch out for crazy high executive pay. I mean, if the company's stock is flat or down, but the CEO is taking home a record-breaking bonus, something's not right. That's your money paying for their third vacation home. The other big one is something called related party transactions. It's a fancy term for management using sneaky ways to shift company money to other businesses owned by their family or friends. It's a huge breach of trust and a sign to get out fast. Okay, enough of the bad stuff. Let's talk about the magic. Let's talk about what happens when you find one of those rare, exceptional leaders. Because when you do, and you invest alongside them for the long haul, the results can be absolutely mind-blowing. Let's look at a few giants from India who prove just how much leadership matters. You have to start with a man like Ratan Tata. He built the Tata Group not just on smart business deals, but on a foundation of ethics and values. That integrity created this incredible level of trust that you just can't buy. When people see the Tata name, they have faith in it. That's a direct result of leadership, and it's an unbelievably valuable asset. Or think about Mukesh Ambani. He took over a company primarily focused on polyester and completely transformed it. He had the vision to see the future in telecom, in retail, in digital services. He basically dragged the company into the 21st century and turned it into this integrated giant. That is what a bold, forward-looking vision can do. And of course, there's Azim Premji of Wipro. He's called the czar of the Indian IT industry for a reason. He built this company from the ground up into a global force. That's incredible leadership, right? But what does that actually look like for the average investor who put their faith in him? Well, let me just show you. Just look at this. Over 10 years, the share price went up more than 5 times over. That is wealth creation. That's not just a number on a chart. That's people's retirements, that's college funds, that's financial security. And it's all driven by putting your money behind a fantastic, long-term leader. This is the goal. So you're probably thinking, okay, this all sounds great, but how do I actually do this?
Well, the good news is you don't need a fancy degree or expensive tools. I'm going to give you a really simple playbook you can use to start analyzing leadership on your own right now. It's really this simple. Pick a company you're interested in, go to their website, and find their latest annual report. Now, don't panic. You don't have to read all 300 pages. Just read the CEO's letter at the beginning. Listen to their last conference call. What's the tone? Are they confident? Are they clear about their vision? You just want to get a bird's eye view, a feel for who's in charge. You'll be amazed what you can pick up. Look, if you take only one thing away from our time together today, let it be this. This is the golden rule. Good leadership in a company will, over the long term, make shareholders wealthy. It's almost an iron law of investing. Forget the day-to-day noise, find great leaders, and you'll find great returns. It really is that simple. So, I'll leave you with this question. The next time you're about to click that buy button, just pause and ask yourself, am I buying a lottery ticket and just hoping for the best? Or am I consciously choosing to become a part owner in a business run by a leader I believe in? The answer to that question could make all the difference. All right, let's jump right in. Today, we're going to pull back the curtain on a secret. You know, it's one of those things that's so powerful, yet so incredibly simple, that many of the world's most successful investors use it to consistently build their fortunes. This is a strategy that lets you cut right through all the market noise by focusing on just one, fundamental sign of a company's real financial health. Let's get into it. You know, I love this quote from J. Paul Getty. It really sets the stage perfectly. He basically understood that if you want to get real results, you've got to learn from the people who have actually built things, people who have taken real risks and won. This isn't about getting a hot stock tip from your buddy. This is about understanding timeless principles that create wealth. So let me ask you a question. Picture a company that's doing great. It's profitable, it's growing. What do you think is its single biggest financial risk? The answer might not be what you think, but I promise you it is the absolute key to everything we're about to talk about. Okay, so here's our game plan. First, we'll reveal the secret itself. Then we're going to build the case against debt, and I mean really look at the high cost of borrowing. Then comes the fun part, the practical stuff. I'll show you exactly how to find these great companies yourself. After that, we'll look at the incredible results this strategy can deliver, and we'll wrap it all up with one simple, powerful rule you can take with you. All right, section 1, the secret. You see, the core idea that savvy investors live by is actually pretty straightforward. They are obsessed with a company's balance sheet, and specifically, they want to know how much money it owes. A clean balance sheet? Well, that's a massive signal of a strong, resilient business. So what exactly are we talking about here? A debt-free company. It's as simple as it sounds, a business with no loans, no IOUs to banks, and the knock-on effect of this is huge, 0 interest payments. See, that money doesn't just disappear. It goes straight to the company's profits, which means more money for the business to grow and, ultimately, more returns for you, the investor. Now let's dig into the why. Why is debt so dangerous for your returns? It's not just some abstract number on a spreadsheet. It's a real mechanical force that just grinds away at a company's potential for growth. And this is the chain reaction right here. It's so simple. First, a company borrows money. That instantly creates a new expense, a mandatory one, interest. And you can't just decide not to pay it when times are tough, like you could with other costs. It has to be paid. So what happens? Profits go down. And when profits go down, there's less money to put back into the business, and less money to go into your pocket as an investor. It's a direct drain on value. Simple as that. So that's the theory. But let's look at what happens in the real world when companies ignore that simple logic. These are some pretty serious cautionary tales about what happens when debt gets out of control. Just take a look at this list. I mean, these aren't small fly-by-night startups. These were huge industrial players, household names in some cases. But they all shared one fatal flaw. They were absolutely drowning in debt. And when the economy turned, those mandatory interest payments became like a giant anchor that just pulled them right under. This is the ultimate risk you take when you invest in a company that's built on a mountain of debt. Okay, that's enough of the scary stuff. Let's switch gears. We've talked about what to avoid. Now let's talk about what to look for, and more importantly, how to find it. This is the hands-on part. I'm going to show you exactly how you can find these financially solid, debt-free gems all on your own. And trust me, it's a lot easier than you might think. Okay, method 1 is the purest and simplest approach. You can use an amazing free tool called screener.in. Just go to the website, find the Create Screen option, and in the little query box, you type one simple command, debt equals 0. That's it. The site will then spit out a list of every single publicly traded company that has absolutely zero debt on its books. It's that direct. Now, of course, a company doesn't have to be perfectly debt-free to be a fantastic investment. So Method 2 helps us find companies with really low, very manageable debt levels. You use the same tool, strainer.in, but this time you type in debt to equity is less than 0.30. This finds businesses that are really financially responsible and not over-leveraged, and it gives us a much wider pool of really great companies to look at. So we know why we should avoid debt, and we know how to find companies that do. But here's the big question. What kind of results can you actually get with this strategy? This is where it gets really, really exciting. Let's look at the proof in the pudding. Our first case study is a pharmaceutical giant, Divis Laboratories. This is a company that's a leader in its field, exporting to something like 100 countries. And the whole time, it has maintained a pristine, completely debt-free balance sheet. Now, just look at the performance here. The numbers really do speak for themselves. Back in April 2012, a single share of this company would have cost you about 398 rupees. Fast forward 10 years to April 2022, and that same share was worth 4,500 rupees. That is more than a 10x return on your money. Just incredible. So what does that performance actually break down to? Well, it's a compounded annual growth rate, you'll hear it called CAGR, of 27%. Just let that number sink in for a second. 27%. That's not some lucky one-year pop. We're talking about a powerful, consistent rate of return, year after year for an entire decade. That is how real wealth gets built. And as impressive as that was, check out this next one, Tanfock Industries. It's a major producer of specialty chemicals. And this case study is a perfect example of how this principle works across totally different industries, sometimes with even crazier results. Look at this journey, it's just unbelievable. In April of 2012, this stock was trading for just 16 rupees a share. 16! By April 2022, it had rocketed all the way up to 589 rupees. I mean, we're talking about a small investment growing more than 35 times over. The numbers here are just mind-boggling. And the growth rate on that one? A jaw-dropping 43%. Compounded annually. Let me say that again. 43% every single year for 10 years straight. This is the kind of explosive potential that gets unlocked when a solid company is free from the anchor of debt and can just pour all its profits back into growing the business. We've covered a lot of ground here, the theory, the real-world risks, the how-to, and some pretty incredible results. But if you walk away from this whole thing with just one piece of advice, I want it to be this next simple rule. Think of it as your North Star for investing. This is it. This is the golden rule. It's not flashy, it's not complicated, but it is so powerful. Never, ever invest in a company that is swimming in debt. Make this the very first thing you check, your number one filter, and you will dramatically improve your odds of success. Why? Because you protect your downside and you position yourself to capture all the upside. And that really brings us to the end. I'm just going to leave you with this one final thought to take with you. The next time you're looking at a company, maybe you're excited about its new product or its great story, before you do anything else, what's the very first number you're going to check on its balance sheet? Thanks for tuning in.
All right, let's dive right in. When you're sizing up a business, what's the one number you check to see if it's really healthy? You might think it's sales or maybe profit, right? Well, today, we're going to pull back the curtain and show you the one metric that tells the real story. And, spoiler alert, it isn't profit.
And this quote, man, it just hits the nail on the head. The most important word in the world of money is cash flow. Think about it. We see headlines all the time, don't we? Record profits, stock prices are soaring. But the real story, the actual lifeblood that keeps the lights on day to day, it all comes down to that one thing, cash flow.
So here's the big question, the one that stumps a lot of people, even seasoned investors. If a company's sales are through the roof and they're reporting great profits, how in the world can they still go bankrupt? It sounds crazy, doesn't it? But it happens, and we're about to find out exactly why.
Okay, so here's how we're going to break it all down. First, we'll look beyond that bottom line. Then we'll get into the cash flow secret itself. I'll show you how to actually measure it, like taking a company's pulse. We'll check out some real-world examples. And finally, we'll see how this gives you a serious edge as an investor. Sound good? Let's go.
All right, Section 1, Beyond the Bottom Line. This is where we talk about the illusion of profit. Because that number that everyone obsesses over, sometimes it's just not what it seems.
And here's the absolute core of the problem. Strong sales do not equal guaranteed cash. See, there's this gap, a huge gap, actually, between when a company says it made money and when it actually gets the money. A company can make a huge sale, record it as revenue, and boom, the profit numbers look amazing. But what if they sold it on credit? That customer might not pay for 30, 60, even 90 days. So the profit is on the books, but the bank account is still empty. Plus, you've got things like depreciation. These are non-cash expenses. It's just an accounting move. No actual money changes hands. This is exactly how a company can look profitable on paper while it's actually running out of cash.
Which brings us to the big secret. If cash is king, then we have to ask the most important question of all. Where is that cash really coming from? Because believe me, not all cash is created equal.
When you boil it all down, a business can really only get cash from 3 places. Number 1, its core operations, actually selling its stuff. Number 2, taking on debt, like a bank loan. And number 3, selling off its assets, like a building or some equipment.
Now, look at those 3 options again. Only one of them tells you if the business is actually healthy. Think about it. Getting a loan or selling a factory, sure, that puts cash in the bank, but it's not a long-term plan, is it? It's like selling your couch to pay for groceries. It doesn't mean your job is going well. It just means you're finding a temporary fix.
And that brings us to the magic term, operating cash flow. This is the one you got to remember. This is the good stuff. It's the pure, honest-to-goodness cash that the company makes just by doing what it's supposed to do every single day. A business with a ton of positive operating cash flow, that's a healthy, sustainable business. Period.
Okay, that's the what. Now for the how. How do we actually measure this? Well, let's get into the investor's toolkit. I'm going to give you a couple of simple tools to take any company's financial pulse.
Tool number 1 is the operating cash flow ratio. Sounds complicated, but it's not, I promise. You just take the cash from the core operations, the good cash we just talked about, and you divide it by the company's current liabilities. And current liabilities is just a fancy way of saying all the bills they have to pay within the next year.
And what's the magic number we're looking for? It's simple. Anything greater than 1. So why 1?
It's because a ratio over 1 tells you something incredibly powerful. It means the company is making more than enough cash from its day-to-day business to pay all of its short-term bills. It's standing on its own 2 feet. It doesn't need to borrow more money or sell things just to survive. Anything less than 1, that's a huge red flag. It means they might have trouble paying the bills. Okay, now for all of you who are looking for real growth companies, here's a little checklist for you. 3 key things to look for. 1. Sales growing at least 20% year on year. 2. Net profit also growing at least 20%. And here's the kicker. Number 3. Net operating cash flow should be positive, and it should be at least 75% of that net profit number. That last one is so important because it proves that the profit they're reporting is actually turning into cold, hard cash.
All right, so this theory is all well and good, but let's see how it works in the real world with some companies you've definitely heard of. Let's see this cash flow thing in action.
First up, a company I'm sure is in a lot of your kitchens, Nestle India. We're going to look at 2 things here, side by side. On one hand, the stock price, what investors think it's worth. And on the other, the net operating cash flow, what the business is actually generating.
Just look at this. In 10 years, the stock price went from about 4,200 rupees all the way up to almost 20,000. That is an incredible run for any investor. So the question is, what was going on behind the scenes to justify that kind of explosion?
And here it is. This is the why. In that same exact 10-year window, their net operating cash flow almost doubled. You see that connection? The stock price isn't just magic. It's following the cash. That strong, growing cash flow is what gave investors confidence, and it's what funded the company's growth. It's a perfect example.
And it's not a one-off. Here's another giant, Hindustan Unilever. Same story, just look at these numbers. Their cash from operations went from under 2,000 crore to over 9,000 crore. That is a cash-generating machine. And that's the kind of financial firepower that lets a company dominate its market for years and years.
Okay, let's wrap this up. What's the big takeaway here? What's the one thing that gives you, the investor, a real edge? It's this simple golden rule. Cash is king, always. Remember, profit is just an opinion. It's based on a bunch of accounting rules. But cash is a fact. A pile of cash in the bank is a pile of cash in the bank. And in the long run, cash flow always wins. And that's it. You now have the secret that the smartest investors use. You know how to look right past those flashy headlines about record profits and see what's really going on. You can see the company's true financial story.
So I'll leave you with this one last question. The next time you see a headline screaming about record profits, what's the very first question you're going to ask yourself? If your first thought is, yeah, but what's the cash flow looking like? Then you've got it. You've unlocked the secret.
All right, let's get right into it. Today, we're pulling back the curtain on one of the most powerful yet simple metrics in all of investing. It's called return on equity, and it's a secret that has helped build some serious fortunes. Let's find out why you need to know about it.
You know, I love starting with this quote from the legend himself, Peter Lynch. It just cuts right to the chase, doesn't it? This isn't about some crazy, complex math that only a genius can understand. If you can handle basic arithmetic, you can handle this. He's telling us that this is accessible to everyone.
And hey, if Peter Lynch saying it isn't enough for you, how about this? Return on equity is a go-to metric for arguably the greatest investor who ever lived, Warren Buffett. I mean, when the best in the business, the absolute legends, are using a specific tool, you've got to pay attention.
So that brings us to the big question, right? What exactly is this thing? What is this powerful number that can help you spot the difference between a truly great company and just an average one? Well, let's break it all down.
Okay, first up, we are going to decode return on equity. We're going to strip away all the fancy jargon and get right to the heart of why this little number is a favorite of billionaires.
At its core, the idea is so simple and so elegant. Return on equity, or ROE for short, basically tells you how good a company's management is at making money with your money. Think about it. For every single dollar you, as a shareholder, have invested in the business, how much profit does the company spit out? That's the question ROE answers. It's a grade card for the management. Now, to really get a feel for ROE, we've got to pop the hood on a company's finances for just a second. But don't you worry, we're not about to dive into some boring accounting lecture here. We just need to know 3 super basic building blocks.
Think of it like this. It's really simple. Step 1, you've got assets. That's all the good stuff the company owns. You know, its factories, its cash in the bank, the products on its shelves. Then, step 2, liabilities. That's everything the company owes to other people, like loans from a bank. And finally, step 3, what's left over when you pay off all those debts? That's the equity. That's the piece of the pie that truly belongs to the shareholders.
And the math? It couldn't be easier. It's literally just subtraction. You take everything the company owns, the assets, and you subtract everything it owes, the liabilities. That number that's left, that's the shareholders' equity. It's the net worth of the company, and it's a super important number.
So this brings us to the magic formula itself. See? Not scary at all. You just take the company's net profit for the year and you divide it by that shareholders' equity we just figured out. You multiply it by 100 to turn it into a percentage, and boom, you've got the return on equity. You've got the secret key we're looking for.
Okay, so that's the theory. It all sounds good on paper, right? But the real question is, does a high ROE actually lead to high returns for investors out here in the real world? Let's stop talking theory and look at some hard evidence.
Okay, check this out. Our first case study is Tata Elxsi. Now, these guys had a massive return on equity of 37.2%. That means they were incredibly efficient at generating profits. So what was the result for investors? Well, between 2017 and 2022, the stock gave an absolutely staggering 65% return per year. Now that is a powerful connection.
Let's look at another one. Abbott India, a big name in pharmaceuticals. Their ROE? A very, very strong 29.5%. And the result for the folks who own the stock over that same 5-year period? An average return of 31% every single year. You starting to see the pattern here? A high ROE seems to point towards high returns.
Okay, one more, just to really hammer this point home. Venati Organics. Their ROE was a solid 20.6%, and the return for shareholders, a whopping 41% per year, on average.
I mean, the evidence is pretty clear, isn't it? There's a very strong link between a company that's great at making profits and a stock that performs incredibly well over the long run.
So, it's obvious now that a high ROE is a good thing. But how high is high? What number should we be looking for? Well, this brings us to the most practical, most actionable part of this whole thing, what I like to call the 15% golden rule. This is your benchmark for quality.
Take a look at our 3 examples, all on one chart. You see Tata Elxsi way up there at over 37%, Abbott India almost 30%, Venati Organics over 20%. And notice how all of them are comfortably, easily clearing that dotted line? That line is our golden rule.
And there it is, the number, 15%. That's it. Simple, right? This is the powerful threshold you should be looking for. Think of it as the minimum passing grade that separates the truly excellent, high-quality businesses from, well, everybody else.
So here's the bottom line, the big takeaway. If you want to find companies that have the potential to deliver fantastic returns, a great first step is to look for businesses that have consistently kept their return on equity above 15%. It's an incredible filter. But, and this is really important, it's just a starting point. Sometimes, a company can juice its ROE by taking on tons of debt, which is risky. So you always want to use this as your first test and then compare it with other companies in the same industry to get the whole story.
All right, let's do a super quick recap so this really sticks with you. What is ROE? It's a measure of profitability, how good a company is at making money with your money. How do you find it? It's just net profit divided by shareholders' equity. And what's the magic number to look for? Make sure it's consistently above 15%. That's your quality filter.
So there you have it. We've just unlocked a secret that legends like Warren Buffett use to find incredible companies. You now have this powerful tool in your own toolbox. So the only question left is, now that you know the secret, which companies are you going to put under the microscope first? The power to find out is in your hands.
You know, when you're looking at different investments, it can feel like you're just drowning in data, right? PE ratios, debt to equity, quarterly reports. It's a lot. But what if I told you there's one single number that can cut through all that noise? A number that helps you spot the truly fantastic businesses and, maybe more importantly, avoid the bad ones. Well, today, that's what we're diving into. It's called Return on Capital Employed, or ROCE, and it might just change the way you look at companies forever.
And to really get why this metric is so powerful, we have to start with a master himself, Warren Buffett. He built his entire philosophy on 2 incredibly simple rules. Rule number 1, never lose money. And rule number 2, never forget rule number 1. Now, I know it sounds almost too simple, doesn't it? But this idea, this absolute focus on protecting your capital, is the foundation for everything we're about to talk about today.
So, here's our game plan. We're going to start with Buffett's rules, then I'll show you the secret metric that really brings them to life. From there, we'll talk about a golden rule, a simple benchmark you can use, and then, the fun part, we'll test it out on some real-world companies like Astral Poly and Britannia. By the end, you'll have a brand new, powerful tool in your investing toolkit. Let's get into it.
All right, so let's really dig into that foundation. Because I think we all get so focused on making money, we forget that the first, most crucial step is learning how not to losing.
Yes, we're looking at these rules again, and for good reason. Their power isn't just how simple they are. The real goal here isn't about chasing the hot stock of the week. It's about finding businesses that are so solid, so well run, that the chance of you permanently losing your money is incredibly small. See, anyone can memorize the rules. The trick, the real challenge is having a system to actually follow them.
So that leads us to the big question, right? Out of the thousands of companies out there, how on earth do we find the special few, the ones that are brilliant at not just protecting capital, but growing it year after year? Well, it turns out there's a number for that, a number that tells us almost everything we need to know.
And that number, that metric, is return on capital employed. You'll see it called ROCE. I want you to think of this as your secret weapon. It's a quick, powerful way to judge the quality of a business and see if it's efficient enough to help you stick to Buffett's most important rules.
Now, before we get into the whole formula, let's break down the first part, capital. It's a simple concept, really. It's just all the money a business has to work with. That includes the money from shareholders, their own skin in the game, and it also includes any money they've borrowed, like loans. We have to include both, because that gives us the total pile of money the management team has at its disposal to try and make a profit. So here's where it all comes together. The ROCE formula is beautifully simple. It just takes the company's earnings and it divides it by that total capital we just talked about. What it's really asking is one single critical question. For every single dollar the company has in its business, how many cents of profit does it spit out in a year? It's a pure measure of how good they are at turning money into more money.
Okay, let's make this real. Imagine a small business. It's got 50,000 rupees in loans from the bank and another 50,000 from its owners. So its total capital is 100,000 rupees. Simple enough. Now, let's say after a year it makes 20,000 rupees in earnings. The math is easy. You take those earnings, the 20,000, you divide it by the total capital, the 100,000, and boom, you get a return on capital employed of 20%.
Okay, so now you know how to calculate it. But this next part, this is where it all clicks. This is where this simple metric becomes a really powerful strategy that you can actually use. I call it the 20% golden rule.
I want you to just look at this number for a second. 20%. If you take only one single thing away from this whole explainer, please let it be this. This is our benchmark. It's the line in the sand that separates an okay business from a truly great one.
And here is that golden rule, stated clearly. If a company can't consistently generate a return of at least 20% on all the money it's using, you probably shouldn't invest in it. Think about it. If a business can't even earn a high return on its own money, how in the world is it supposed to generate a high return for you as an investor over the long haul? It's just not likely. Okay, theory time is over. Let's see how this golden rule holds up in the real world. Time to put it to the test with our first case study, a company called Astral Poly. So, Astral Polytechnique, they're in the plumbing and drainage business. Not exactly glamorous, right? But look at the numbers. Their return on capital employed is 22.6%. Now here's the kicker. Between 2017 and 2022, what did that business do for its shareholders? It delivered an average annual return of 44%. That is not a coincidence. That is what a high-quality business does. You can see it right here. Astral's ROCE sails right over our 20% golden rule benchmark. This incredible efficiency, how well they use their money, is directly tied to the incredible performance that shareholders saw in their brokerage accounts. This is exactly what we're looking for.
Okay, that was a good one. Let's look at a couple more you've definitely heard of. This is really going to cement that link between a high ROCE and fantastic returns, and it'll show us the difference between what makes a business great and what makes it truly exceptional. All right, next up, Jubilant Food Works. These are the folks who run Domino's and Dunkin' here in India. What's their ROCE? 21.1%. Once again, clearing our benchmark. And what happened for shareholders? An amazing 42% average return per year over 5 years. A pattern is definitely starting to emerge here, isn't it? Operational excellence translates into shareholder wealth. And again, you can see it plain as day. Jubilant easily passes the test. I mean, just stop and think about that for a second. A business that year in and year out generates over 21 cents a profit for every single dollar of capital it has, that is a powerful, powerful wealth-creating machine. But here's where it gets really, really interesting. This is where we see the gap between a great company and an exceptional one. Look, Jubilant's 21.1% is fantastic, absolutely fantastic. But then you look at a company like Britannia Industries, a 100-year-old company we all know. Their ROCE is a staggering 41.5%. That is a business operating on a whole different level. It's in a class all by itself. So we've walked through the theory. We've seen how it plays out with real companies. Let's boil it all down now into a simple, practical tool that you can literally start using today for your own portfolio. Okay, here are the big takeaways. Number 1, always, always start with that Warren Buffett mindset. Your first job is to not lose money. Number 2, use ROCE as your go-to metric for judging the basic quality of a business. 3, the golden rule. Actively hunt for companies that have a consistent ROCE of 20% or more. And finally, number 4, never forget that powerful link we've seen today. A high ROCE is very often a sign of high future returns. So I'll leave you with this question to think about. The next time you're researching a company, the next time you're thinking about putting your hard-earned money into a stock, what's the first rule you're going to remember? And what's the first number you're going to look for? If your answer is never lose money and a ROCE over 20%, then you're already on the right track to becoming a much smarter investor.
You ever look at those really successful investors and wonder, how do they always seem to find the great deals before anyone else? Well, it's not some kind of magic, and it's definitely not just luck. Today, we're going to pull back the curtain on one of the most powerful and surprisingly simple tools they use for buying stocks at a low cost. Let's dive right in. And we're going to start our journey with this piece of wisdom from the one and only Rakesh Jhunjhunwala. It's such a simple idea, but it's profound. Find the real underlying value. Don't just chase whatever stock is popular this week. This idea right here is going to be our guiding star for this entire explainer. So, to get our heads around this, let's start with something we all understand: real estate. Imagine you have a choice between two properties. Property number 1 costs 25 lakh and it brings in 10,000 a month in rent. Okay, property number 2, it's a bit pricier at 30 lakh, but the rent is 15,000 a month. So, which one's the better deal? It's the second one, right? No brainer. Yeah, you pay a little more upfront, but your return, your rental income is 50% higher. You're getting much better value for your money. That exact same logic is what we're going to apply to the stock market. Okay, so here's our roadmap for today. First up, we're going to nail down what good value actually means. Then we'll learn how to read the mood of the entire market. After that, we'll zoom in and see how to size up a single stock. We'll also dig into the story behind the numbers. And finally, we'll wrap it all up with the investor's golden rule. So you see, just like we picked the property that gave us more rent for our money, smart stock investing is all about finding companies where you get the most earnings for the price you pay. We're just swapping properties for portfolios, but that core idea of value, it stays exactly the same. And the number one tool we use for this is called the P/E ratio. PE, it just stands for price to earnings. Honestly, you should think of it like a price tag. It tells you how expensive a stock is compared to the profit it makes. More specifically, it tells you exactly how many rupees you have to invest just to get one single rupee of that company's earnings back. This little ratio is our key to figuring out if a stack is a real bargain or maybe a disaster waiting to happen. So let's start big picture. Before we even think about picking one stock, the PE ratio can give us a feel for the entire market's mood. Is the market feeling optimistic and expensive, or is it fearful and cheap? It helps answer that giant question every single one of us asks: is now even a good time to be investing at all? And here in India, our go-to-market barometer is the Nifty 50. It's basically a basket of the top 50 companies, and when we look at their combined PE ratio, we get a fantastic snapshot of how the whole market is valued. Is the market on sale, or is it overpriced? The Nifty PE gives us a really solid clue. Now this is where it gets really interesting. Historically, we can see these clear zones for investing. Look over on the left. That's what I'd call the green zone. When the Nifty PE is down between 10 and 15, historically, the market is cheap. It's undervalued. That's a great time to be a buyer. But when it starts creeping up past 25 into that red zone, well, that's a signal to be a lot more careful. History shows the risks are just plain higher. And this slide shows you exactly why it matters so much. Look, on the left, at a market PE of 10, the odds are really in your favor. You only have to invest 10 rupees to get 1 rupee in earnings. That's a 10% return. Pretty solid. But now look at the right. At a PE of 30, the game is stacked against you. You have to put in 30 rupees, 3 times as much, to get that same 1 rupee of earnings. Your return collapses to just 3.33%. I mean, at that point, a fixed deposit is safer and pays more. It's a huge red flag. And you know the best part? This isn't some secret Wall Street formula. It's public information. You can go to the official NSE India website right now and find all this historical data for yourself. You can literally run your own analysis. The power is right there at your fingertips. Okay, so now that we know how to get a feel for the whole market, let's zoom in. It's time to take out the magnifying glass and use this exact same PE logic to find value in individual companies. Now to do that, we first have to understand the E in PE. That's the earnings per share, or EPS. The idea is really simple. You take a company's entire net profit for the year and you divide it by the total number of shares out there. What you're left with is the slice of the profit that belongs to each individual share. And calculating the PE for any stock is so easy, it's just 3 steps. First, find the current price for one share. That's your P. Second, find its earnings per share. That's your E. And third, you just divide the price by the earnings. P divided by E. That's all there is to it. So let's run a quick example.
Let's say a stock is trading for 150 rupees a share, and its earnings per share is 10 rupees. You just do the math. 150 divided by 10 gives you a PE ratio of 15. Simple. What that means is you're paying 15 rupees for every 1 rupee of that company's profit. But this leads us to the most important question, doesn't it? We have this number, 15. So what? Is that good? Is that bad? Is it high? Is it low? The truth is, on its own, the number 15 tells us absolutely nothing. A PE ratio without context is totally meaningless. So how do we get that context? Well, here's the key. A PE ratio is only useful when you compare it to something else. And you have to compare apples to apples. You can't compare the PE of a high-growth IT company to, say, a slow and steady FMCG company. It just doesn't make sense. You have to compare it to its direct competitors, its peers, in the very same industry. Okay, let's look at this table. Imagine we're analyzing an IT company. We'll call it Company X. We calculate its PE, and it comes out to 15. Fine. But then we look up the average PE for the entire IT industry, and we see that it's 25. Well, all of a sudden, our PE of 15 looks pretty darn good, doesn't it? It's a clear signal that this stock might be cheaper than its peers, that we might be onto a potential bargain here. All right, so finding a stock that looks cheap compared to its rivals is a great start. But this is where the real work of an investor begins. You cannot stop here. A low PE is just a clue. It's not the final answer. Now we have to put on our detective hats and figure out the story behind that number. Why is it so low? See, a number can tell two completely different stories. A high PE could mean a stock is in a dangerous bubble and totally overvalued, or it could mean the market sees a fantastic future and expects huge growth. And on the flip side, that low PE we found, it might be a hidden gem, a great company that the market is overlooking, or it could be what we call a value trap, a company that's cheap for a very good reason because it's in serious trouble. The number itself doesn't tell you which story is true. Your job as an investor is to find out. And that right there, that brings us to the real goal. We're not just hunting for low numbers on a screen. We are looking for that perfect intersection, that sweet spot where two things meet, a fundamentally solid company with a good future that for some reason the market is currently undervaluing. That's where you find the real opportunities. So, this brings us to our final and, I think, most critical piece of this puzzle. This is the rule that pulls everything we've talked about into one clear, actionable strategy for you to use. And here it is. This is the golden rule. You start by finding a company with a lower PE than its peers. But, and listen, this is the most important part. You only consider investing if it also has real growth, solid profitability, and positive cash flow from its operations. Let me say that again because it's that important. The PE gets your attention, the health of the business is what should make your decision. Think of the PE ratio as your first filter. It helps you narrow down the universe of stocks. But it's not the final answer. Before you ever put a single rupee to work, you have to do a basic health check on the business itself. You look at these things here. Are its sales actually growing? Is it making a real profit? Is it using its money efficiently? And maybe most importantly, is it generating actual cash? These are the questions that separate good investments from bad ones. So there you have it. The PE ratio is an incredible tool. It's like a map that can lead you to buried treasure in the stock market. But having the map, that's the easy part. The real question is this. Do you have the discipline to actually follow it, to do the extra homework, and to have the patience to wait for the right moment? Because ultimately, that is the true secret to long-term success in investing.
All right, welcome. Today, we're going to pull back the curtain on a really powerful secret for investing smarter. And it's all about learning how to track the trend. Now, this is a fundamental skill. Think of it like a protective shield that can guard you against some of the most common and, frankly, most painful mistakes an investor can make. We're going to build a framework here that adds some real discipline to your decisions. So let's just dive right in.
The legendary investor Rakesh Jhunjhunwala really just hit the nail on the head with this. Investing is all about spotting opportunities. And a huge part of that, one that a lot of people overlook, is spotting the direction of the market's enthusiasm for a company. See, a great business is one thing, but a great business in a powerful uptrend, well, that's where the real magic happens.
So here's our game plan for this explainer. First, we're going to dissect a really common and painful mistake I call catching a falling knife. Then, we'll get to the good stuff, the secret to avoiding it, which is just following the trend. After that, I'm going to give you the exact tools you'll need, Introduce a simple but incredibly effective rule, the above 60 rule, and then we'll wrap it all up by seeing how it works with a real-world example.
Okay, let's kick things off with a scenario that might feel, well, a little uncomfortably familiar for a lot of us. It's what's known as the falling knife problem. And believe me, it's a trap that has caused a massive amount of financial pain out there. It's an emotional trap just as much as it is a financial one. And understanding it is the absolute first step to avoiding it for good.
No, really, think about it for a second. You've done your homework, right? You found a company you really believe in, the story is fantastic, and you pull the trigger, you buy the stock. And then it starts to drop. So your logic kicks in. Hey, it was a good buy before, so it must be an amazing buy now. You buy more, totally convinced you're getting a bargain, and it just falls again and again. Sound familiar? It's just an incredibly frustrating feeling that can really shake your confidence.
So this behavior, it has a name. It's called averaging down. And on paper, it seems so logical. You're just lowering your average cost. But here is the critical difference. If you are buying more without a clear, evidence-based reason for that stop to turn around, you're not investing anymore. You're just hoping. You're gambling that the fall is going to magically stop.
And listen, this isn't just some abstract theory. This is a graveyard of real-world money. I mean, just look at what happened with Yes Bank. As its price absolutely cratered from 270, countless investors just kept buying, averaging down the whole way, only to watch their money basically vaporize. The exact same tragedy happened with DHFL. People kept pouring money in, convinced a rebound was just around the corner, and that value was never seen again.
This, right here, illustrates the mental trap perfectly. On the left, that's what we tell ourselves. I'm a smart investor. I'm getting a wonderful company on sale. But on the right, that's the brutal reality of what's happening in the market. You are literally trying to catch a sharp, heavy, falling object with your bare hands. And what usually happens when you do that? You get hurt. Badly.
So, how do we avoid this painful trap altogether? Well, the secret is surprisingly simple, but it is profoundly effective. We learn to follow the trend. Instead of trying to swim against a powerful current, we learn to identify that current and just ride it in our favor. It's all about replacing blind hope with clear-eyed observation.
So first things first, what exactly is a trend? It's just the general direction a stock's price is moving over time. And the most important thing to get your head around is that prices never move in a straight line. They just don't. They move in a series of waves or zigzags. There are pushes up and pullbacks. Our job is to ignore the tiny daily wiggles and just identify the overall path of those zigzags. And when you boil it all down, there are really only 3 types of trends you need to worry about. First, you've got an uptrend. That's when the zigzags are climbing, making higher peaks and higher valleys. Simple. A downtrend is the exact opposite, a series of lower peaks and lower valleys, a clear sign of weakness. And then you have consolidation, which is when the price is just stuck, bouncing around sideways, trapped between a floor and a ceiling.
And this brings us to the most important rule of this entire strategy. If you remember nothing else from this, remember this. We only want to put our hard-earned money into stocks that are in a clear, confirmed uptrend. We actively, purposefully avoid stocks in a downtrend, no matter how much we love the company or its story. This one rule is your best defense against ever catching a falling knife again.
Okay, that sounds great. Buy the uptrend. Easy enough, right? But how do we actually see the trend without letting our emotions get in the way? For that, we need to open up our toolbox. We're going to use a few basic tools from technical analysis, which is really just a fancy way of saying we're using charts to understand what the market is doing.
Here's everything you need. First, a decent charting platform. TradingView is a great one, and they have a fantastic free version. Second, always, and I mean always, use candle charts. They just give you so much more information than a simple line chart. And finally, and this is so important for investors, we look at weekly and monthly charts. The daily charts are just full of noise. The longer time frames, that's where you see the real underlying trend.
And now for our secret weapon. On our charting platform, we're going to use an indicator called the Relative Strength Index, or RSI. Now, don't let the fancy name intimidate you. All it does is measure momentum. Think of it like a speedometer for the stock's price on a simple scale from 0 to 100. It tells us how strong the buying or selling pressure is. A stock that's barely moving up has weak momentum. One that's rocketing higher has strong momentum. RSI just puts a number on that.
So this brings us to the core strategy, the thing that makes all of this practical. It's a simple filter based on the RSI that's going to become a non-negotiable checkpoint for you. This is the above 60 rule, and it's designed to do one thing:
keep you on the right side of the trend.
Now this table just cuts through all the noise. It's so simple. If the RSI is below 40, the trend is bearish. What do? Simple. Do not buy. If it's bouncing around between 40 and 60, the market's going sideways. Again, you stay on the sidelines. It's only when that RSI breaks and holds above 60 that it's flashing a sign of a strong, bullish uptrend. That's our green light to even start thinking about buying the stock. It's the first test it has to pass.
This chart gives you a great visual for it. Just think of these as 3 different zones. Our entire hunting ground, where we spend all our time as investors using this strategy, is in that highlighted bullish zone. We let other people try to guess what's happening in the neutral zone, and we let them try to catch knives in the bearish zone. We wait for strength. Period.
And here's how we dial this in for our own goals. An RSI above 60 on a daily chart? Okay, that shows short-term strength. But for us, as long-term investors, the real confirmation comes from the weekly and the monthly charts. A weekly RSI above 60 signals a solid medium-term trend. A monthly RSI above 60, that signals a powerful, established long-term trend. That is the sweet spot. That's what we're looking for.
Okay, enough with the theory. Let's put this to the test. Let's see how this plays out in the messy real world. Does this simple little rule actually hold up? We're going to look at a case study with one of India's biggest, most well-known companies, Reliance Industries. This is going to make it crystal clear. So take a look at this 5-year window for Reliance, from 2011 all the way to 2016. A lot of investors bought in during this time thinking, hey, it's a giant company, it's a fair price. But if you had just applied our simple RSI filter to the weekly or monthly charts, you would have seen that the RSI was stuck below 60 consistently. The stock was just going sideways. And the result? For 5 long years, investors who held that stock made almost no money. It was dead money. That above 60 rule would have been your unemotional guide. It would have screamed at you objectively to just stay out of the stock during that long, frustrating sideways grind. And just as important, it would have flashed a bright green light when the RSI finally broke above 60, right before the stock started its next massive multi-year run-up. It tells you when to be patient, and it tells you when to get interested.
And this really gets to the golden rule of this whole secret. Look, this isn't about finding some magic crystal ball that's right 100% of the time. Nothing is. This is about managing risk and playing the probabilities. The more you understand and actually apply simple trend analysis, the more you tilt the odds of success in your favor. It's that simple.
So let's lock in the key takeaways from today. Number 1, just promise yourself. Stop trying to catch falling knives. Your capital is too precious. 2, get comfortable with candle charts. Learn to spot an uptrend, a downtrend, and consolidation. 3, make the RSI above 60 rule on weekly and monthly charts your go-to signal for a healthy bullish trend. And finally, make this a non-negotiable step in your process. Apply this filter before you even think about investing.
And that brings us to the end. But I want to leave you with a challenge, a direct call to action. Right now, pull up your stock watch list. Which one of those companies are you going to analyze first using this above 60 rule? Go on, do it. The answer might just save you from your next big mistake. Thanks for joining me.